All right, everything looking good. Should be live and ready to roll. Somebody could just let me know in the chat that we're coming through loud and clear. I would greatly appreciate it, as always. But in the meantime, let's go ahead and get the stream started. Welcome back to the channel, Crypto Trend Trader, with our Sunday evening market look ahead. It is 8 p.m. Eastern Standard Time on 6/12/2022. Before we get started, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. All right, so we know that we wrapped up our Friday evening, or I guess Friday close in traditional markets at the lows. And typically, statistically speaking, we can count on continued selling the following Monday. So, and the rationale behind that is essentially when we close at the lows, not off of the lows. And once again, if we close off the lows, it means there was selling going into the close, and then there was some buying towards the end of the day, or at least sometime during the day that left a wick behind. We didn't just sell down and then stop. So, you've heard me say it many times before, but, we didn't run out of time, or I'm sorry, we didn't run out of sellers. We ran out of time. So, there was still people selling literally right up until the close of the markets. So that being said, regardless of what we see happening, extended hours or, pre-market futures, etc., typically what we see when we close at the lows is continued selling going into that following Monday. And then, that might last for weeks, months, or we might get a turnaround Tuesday and it bounces from there. That being said, I don't think that that's going to be the case, but let's go ahead and take a look at some of these charts here. And, that being said, before we jump into our crypto and everything, we're seeing now that not only have we been seeing extreme weakness in crypto and we're essentially revisited the closes, but we put in a lower daily close now, the lowest daily close we have literally had in years at this point in time, a new cycle low since we peaked. And, we do have a capitulation wick on the initial dump that went a little bit lower, but we're at the lowest close already. So we'll talk about that a little bit. We did get a little bit of a gap down. We have another gap down on crypto. So we'll take a look at those and see where those are at and pay attention. But the most important thing is with gaps is when you have a gap to the upside and then you move below it, eventually you will fill that gap unless you don't ever revisit these levels. So whether it takes a month, a year, a decade, as long as eventually you revisit the highs or return to all-time highs or wherever the gap is at, eventually you fill it. That's not always the case with like a breakaway gap, where we move above, where we gap up and then just continue, which is called the breakaway gap. And essentially, those sometimes never get filled. And, it's possible that we never fill a gap to the upside, but it means that you just never put in new all-time highs again. So typically, you're looking at essentially a dead asset. Anything that goes through like multiple cycles or extended periods of time without putting in a new all-time high, is eventually, essentially a dead asset because it's not growing. It's essentially dying. So it might not be dead yet, but it's on the way. So that being said, we'll take a look at the crypto gaps. We'll take a look at, the psychology, momentum indicators, oscillators. We'll talk a little bit about strategy. We're going to take a look at the VIX again and talk about how we predicted this move. Talking specifically about what we saw in crypto and traditional markets based on our VIX support levels. So we'll revisit that a little bit and then we'll talk about some potential targets as well. So let's go ahead and jump right in. Getting some weird notifications from YouTube on the stream. It looks like it's okay, but it says an error occurred. So let me know if you guys are having any issues along the way. I'll try to pay attention to chat, but I'm just going to keep going, assuming that everything is okay. So Calma Betty, what's up? Bitcoin to 10K. Yeah, hey, what are you going to say when Bitcoin does hit 10K? What are you going to have a new target to the downside, or are you going to have a target to the upside after that? Good to see you, Parag. Appreciate you. What's going on with you, man? Hey, thank you very much. I appreciate that. Yeah, it looks okay. There's something going on with the display where it's basically saying there's like an error, like the stream's not going, but it says we're live. So as long as you guys can see it, That's all that matters. Jay Hoff, good to see you, man. Yeah, let's go ahead and learn something. That's the goal every stream, to make sure that we are learning something new. So let's take a look and see what these markets have to tell us. See what these breadcrumbs are pointing to. So TNX first, 10-year Treasury yield. We have officially put in a new cycle high. So not only did we essentially close at the high, but we have a slight little wick above it. So once again, as long as we're putting in new cycle highs, I expect us to continue putting in new cycle highs. And you guys know the level we're at right now is literally the most crucial level. Basically 2018 highs, and we're at the peak from 2018. So, we've talked about this countless times. We've been literally talking about the implications of this for years. And we know that once we break above this previous high right here, if we break above that high, which we're essentially at right now on the monthly, if this monthly closed right now, which we still have, 18 days, so we're not even close to that. But if it closed right now, we would be closing at those same highs. So if we see any further movement to the upside, a close any higher in the next 18 days than where we're at right now, we will be taking out this previous high. And we know what that means. We know what it means. When you're constantly when you're in a downtrend and you're constantly putting in a high, then a low, then a lower high, and lower low, lower high, lower low, lower high, lower low. You're in a downtrend. You're consistently just doing the same thing over and over again. No one's going to get bullish. I mean, you might get bullish for a short term. People might get bullish because they're brain dead, but no actual technical trader is going to get bullish because we're not doing anything that is the beginning of a reversal in the trend. So what we're actually doing now, though, is we're taking out that previous high. So we're breaking the cycle. The cycle has been a high, then a low, then a lower high, then a lower low. So here when we put down this lower low, the last thing we did before that was put in another lower high from the previous highs. So the second we take out this lower high right here, assuming we do, which we're very, very likely going to, the market is very strong right now. We have a bunch of momentum in our favor on the monthly. We have extreme, bull case on the stochastics as well. And then, of course, we're above the 200 exponential and simple. So right now, it looks like we're going to take out this level. And if we do, we will no longer have put in a lower high right here. So let's say this thing just barely goes a little bit higher, and then it rolls back over, and then we come back down. We no longer have that pattern happening where we have a lower high, a lower low, and then a lower high. So now we'll have a higher high. So now it's the beginning of what amounts to an uptrend. So that is so, so important. And I know I drill it in all the time how important the DXY and TNX charts are. I know it's probably annoying because the majority of you know that. But these are literally the most important charts right now because we're looking at a 40-year trend that is literally breaking out. If there was a point in time over the last 40 years, this is probably the most important time because we're potentially breaking out of that 40-year trend. So if we see that breakout take place, we're going to see something happen that hasn't happened in the last 40 years. So everything everyone's been doing, trading, investing, whatever, for the last 40 years, stocks, cryptos, housing, any possible thing someone was speculating, investing, trading, whatever, it's going to be different now. Things are different. It's going to be the first time in 40 years when things are different. So everything that's been working for the last 40 years is no longer going to be reliable. And that is why this is so freaking important, and I'm constantly talking about it. So, we've drilled that home a ton. We're obviously at those levels. We're very, very close. We're going to find out in, basically 18 days. We're going to confirm on a monthly whether or not we get the breakout. If we don't, maybe we have to wait another 30 days to see. But it looks very, very close right now. And then when we start to look at essentially like shorter time frames, when we go to the weekly, this will obviously trigger sooner if we get a higher weekly close. But the levels will be different because there's a slight wick on that 2018 level. So basically the highs right here was 3.248 and we're still at like 3.155. So we're still slightly below it, but as early as this week, we can confirm that breakout. It doesn't have to be till the end of the month. And then if we go to the daily, the daily has already taken out the short-term high. And then when we zoom way back and look at this, we see, it's basically the same exact level, same high, give or take a small fraction. But when it's all said and done, we will find out on a daily even sooner than that. So the second that we basically come in here and close our first daily candle above, roughly 3.236. That is daily confirmation. And then at that point in time, we look for the weekly confirmation. And then at that point in time, we look for the monthly confirmation. So we could literally start seeing these confirmations, as early as tomorrow, and then again on Friday, and then essentially like the following, like a little over a week after that. So we're literally at the point where we could see these breakouts confirming in the next day, week, month. So it's very, very important that we are extremely, I don't want to say necessarily conservative, but defensive right now. We need to be defensive right now, because if this confirms and breaks and the trend changes, the implications of a potential move, the velocity of that move, the intensity of that move could be like something we haven't seen, as essentially like bots, algorithms, traders, market makers, whales, all essentially flip from a long-term bearish to a long-term bullish, which, a lot of people already have. Obviously, we've been very bullish on TNX for quite some time now. I mean, literally since the bottom. So, and then the same thing, obviously, with TLT, the implications for TLT, if we see this breakout now from this level, the implications on TLT could be, I mean, just massive, because this thing right now, and let's be real. Let's be real right now. We have lightweight already confirmed breakouts on many different ways. But the channel on TLT right here, the 20-year Treasury bond itself, we have technically already broken down from the channel the same way that we have technically already broken out. The only difference is, we're essentially threatening that 2018 high on the yields. Here we're threatening the 2018 low on the bonds. So again, once we bust through this, if this fails, we start to capitulate down out of a channel we've been operating in for, a long time. Lots of steps along the way. Obviously, we would expect it to be like a stair step on the way down with small bounces. But, the next key level to pay attention to on the TLT is essentially like 100. It's 102 or something like that. But, essentially that 100 level is what we're watching. Massive, massive move. And obviously this head and shoulders has played out beautifully. We have the essentially like measure move of the head and shoulders. We have measure move of the channel. Those are long-term targets that probably never get hit, just because there'd be such violent moves. I would imagine that, things would change if we started to get that violent of moves, especially because of the size of the debt market. The bond market is massive compared to the stock market. And I think a lot of times people don't realize that. So next we talk about the VIX a little bit. So we were discussing the VIX here, and essentially how we have this massive descending channel, broke out of the channel, and then we have this ascending channel. Depending on what time frame we're on, we use either the white horizontal channel right here, or we have a blue support bottom and a red resistance top right there. Depending if you're going by wicks, depending on what time frame you're going, you draw this a lot of different ways. But overall, it's been very, very technical. We clearly have, and this is a perfect example of what a breakout looks like and what we're looking to happen in DXY and TNX. We had a massive move to the upside. That was a blow off top. That was a peak high. And then from that point in time, that was obviously the Rona dump scare. And then from that point in time, we just put in a descending channel. So it was literally exactly what we were just talking about. We have a high, then a low, then a lower high, then a lower low, lower high, lower low, lower high, lower low. And we just keep going like that. What is important to notice, though, along the way, sometimes when price action is developing, and this is not going to be a 5-wave structure by any means, I just want to use it because it's easy to use this drawing tool because it gives me a bunch of uses of it. But essentially we have, that's one move down, that's one move up. And then this is one move down right here. And then you could get tricked if you didn't know what you're doing with this move up right here and then think, okay, that's a lower high. And then we come down and then, oh, we bottom right here. So now we have a higher low. So now we might be starting an uptrend. And then all of a sudden, you literally come up here and the next move is a new high. And you're like, oh, look, we have a low right here. Then we have a, high right here. Then we have a higher low right here. Then we have a higher high right here. So you're like, oh, that's it. We're in an uptrend now. So no more downtrend, right? That's obviously not the case because, we can see now, obviously in hindsight, how it developed over time. But the fact of the matter is that, this ended up being just a portion of this move. And then the next move down was there. So really, this was just an internal move inside of our like swing low, swing high. So you have to be careful you don't get tricked right here. The way to not get tricked with those situations is to have other ways that you can look for confluence, like essentially a resistance channel or support channel, because it seems odd that we basically, kind of just top out in random places. So we're looking for some kind of confluence, whether it is, you know, a bunch of highs, a bunch of lows, you know, a Fibonacci, a moving average, whatever it is. We need some other form of confluence. You know, our indicators, our oscillators telling us a trend is picking up or building momentum. We're seeing convergence on the moving averages. We're seeing divergence on the moving, you know, lots of other ways that we can use that confluence so we don't end up getting tricked right here. So that being said, because if you thought we broke out right here and this was like a new high and then you were long, next thing we did was just put in a new low. So you just got wrecked. So then again, we continue on and we put in another lower high. And then again, this is, you know, internal moves right here. That's our next lowest low. Then we have another lower high. Then we have another lower low. And then this is the area where we started looking for, we had this key support level that was holding up. And that's when we were looking for short-term bullish divergence, you know, essentially marking this as a bottom to come up and threaten, you know, the top and get the breakout. Now, it's not always going to happen like that. We're not always going to get every call perfectly. Obviously, this one we did. We called it perfectly. But that's not always going to be the case. We're not always going to pick absolute tops and absolute bottoms. But if we use methods that have a high probability of success, you know, we go from whatever a normal person's chance of picking a high and low. Let's just say, for instance, you have a 1 year long trend and you're trading on a daily chart. If you want to pick the high or the low of that 1 year, the absolute high or the absolute low, you have a 1 in 365 chance of being correct. You know, just by days, you know, just if you literally just picked a day and you were like, that's going to be the high. So the only way you can improve on your odds of that 1 in 365% chance is by using technical analysis to identify key areas or momentum or something else like that. You know, whatever your method is gives you an edge over the market. So maybe you can get it to where you have a 1 in 200 chance, or maybe you have a 1 in 100 chance. So you're exponentially like have an edge over the market, but still the probability is extremely, extremely low of success. So that's why you don't want to count on it. You want to always be ready to be wrong. But, you know, you do it enough times and have a nice method, and a lot of times you will get, you know, whatever you want to call it, lucky, or you'll find success through consistency, whatever. So that being said, you know, this is where we start to threaten that level with a wick right here. Now, obviously, we still have a lower close, so we haven't actually broken out yet. So we're still in that consistent downtrend. And then, obviously, this is where it really gets interesting, because this is essentially us coming down. We put in that same low right here, and then we actually put in bullish divergence off of that low support. And then at that point in time, we come back down, retest it, and then we just take off. So then as soon as we take off right here, after the bullish divergence, obviously we get bullish right here. You know, you go back, we talked about it, how we were extremely bullish on volatility, et cetera, et cetera. Complacency in the markets was out of control. You know, it was just getting ridiculous. And obviously at that point in time, we started to see other key signals. Like, you know, obviously we take out the heart line right here, then we threaten the top of the channel, then we break out of the top of the channel. We've also put in a new high from the previous high now. So again, we see a bunch of confluence telling us this is a confirmed technical breakout. This is a new high for the first time, you know, this whole trend on the way down here. And then essentially what we were looking for after that breakout was, you know, and we talked about this specifically, is we said it would be nice if we held right above the channel, but we don't think the probability is extremely low that we're just going to break out and then hold right here and then just go higher. So what we wanted to see was our next move down, come down and put in a higher low, because that for us is the beginning of that trend. So now we have this high, then we have that same low again, then we have a higher high, then we have a higher low. So then again, obviously next thing we're looking for, another higher high, which of course we get. And then, you know, depending how you look at it, another higher low here, or realistically, you know, this was, yeah, I mean, regardless how you look at it, if you look at that as an internal move or not, technically, you know, this was actually a higher high because it gapped up and then moved down. So if you're going by the wicks, if you're on a weekly or a monthly time frame, maybe it looks slightly different. But again, doesn't really matter, because essentially what ends up happening here is we come down here, and that could trick a lot of people into thinking we put in a lower low now and we've broken down from this channel. But again, in my opinion, again, in my opinion, you know, that's just people basically getting tricked. I think I messed that up because yeah, we'll just put that back real quick. So when we come up here to this one, you can look at this in multiple different ways. Realistically, at the time, this looked like the higher high, and then we come back down here, put in a higher low, and it still looked good, but we didn't hit the bottom of the channel. So it's kind of a little sketchy, but then we start going up here. We actually put in a higher high right here, and then we come down and put in a lower low. So the real question is this a move right here? Or more accurately, this is probably our move. And then now we have again a high, then that same low again, then a higher low, higher high, higher low. And then again, we're coming up here now and we're in the process of the move. So, what do we think is likely to happen at this point in time? Well, what's likely to happen is we come up here, eventually, we come back down and then eventually get another push up here. So is this going to be a lower high? It's possible, but I think more realistically, this is just part of our next move. And now that we come back down, hit support, we're probably going to come back up to the top of the channel. And then at that point in time, we're going to start visiting the big red box area. And we know that that is the area where we look for extreme levels in the market. Whether it's extreme volatility, it's typically going to be like a spike high on the VIX or spike low on the markets. And that's what we're looking for. And then after that, obviously, we would expect, the trend to just kind of continue bouncing around in here. And then eventually we would look for, potential breakout of the trend, either to the upside or to the downside, etc. But this right here, this move that we saw take place in the markets on the VIX is essentially what we're looking for to take place on the DXY and the TNX. Because once we get that confirmed breakout, once we start taking out the highs, once we start putting in higher highs and then higher lows, once we get a breakout of key resistance or above key moving averages, or take out whatever key level you're looking at, a Fibonacci, etc., the entire market's going to start going from this is clearly a downtrend to this is clearly an uptrend. And the market still has not even admitted or come to terms or discovered or copied or whatever that this is actually, the VIX is actually in a bull trend right now. There's still a macro bear trend right here, but we've broken out of it. We're no longer in that trend as far as the channel, and we're no longer putting in lower highs and lower lows. So the VIX is bullish now, no matter how you want to look at it. We're above. I don't like to really use moving averages and stuff the same way on the VIX or as reliably, just because the idea of this is to essentially just oscillate. It's not like a stock or something like that where it's constantly going up. Theoretically putting in new all-time highs. You're not going to get that in this because it oscillates within a range the same way that one of our indicators would. So the moving averages are a little less useful, but when we really zoom out and we look at the big picture right here, this is going back to like 1990 essentially. So we have about 30 years worth of data right here, which is obviously pretty nice. But we can look at key times in history in this 30-year period and see how do those things correlate. We have like our lows right here basically in 93 in the VIX. We have our lows around here in 2005 in the VIX, and then we have our lows here in 2007. So it was about, I believe it was the 12-year cycle is what we were looking at. Is that right? 93, 05, and 2017. Yeah, so it's about 12 years apart from the lows. And this low that we put in right here was December 2017. I'm sorry, November. Well, right around there. Anyway. And then for the highs, we've, and again, every time we did that, even though we kind of double tapped right here, even though we kind of tapped right here, and then we spent a little time hanging out in it, those were macro swing lows in volatility. And now, again, we're looking for the macro swing highs in volatility as well. So when we enter into this red box area, this is extremely, extremely important, because in the 30-year period, we wicked inside of it here once. We touched it here with a wick. We wicked inside of it here once. We spent some time inside of it here in 2008, which was obviously a big deal. Again, we wick inside it here. We wick inside it here. We wick inside it here, and then we actually go inside it again here. So we've really only actually been inside of this area on anything more than, 1 or 2 wicks twice in the last 30 years. So, we're not there now, but, we're pretty high up on the range. And if we do potentially bottom right here and come up and put in a new high, we're essentially threatening that resistance, that, red box. So that's when we could really start on the macro looking for a swing low in the markets and start really saying, okay, the bottom might actually be in on this. Now, that doesn't have to be the case. We could come up here and it could get nasty. The markets could sell off and volatility could actually come down. We could see a whole, infinite amount of possibilities take place. But we know that this is consistent and we know that it's useful as a tool to help us get that confluence that we're looking for. So the VIX is very, very important. And you don't have to look at volatility of the S&P. You could look at the NASDAQ or something. I like using the S&P and Dow Jones specifically as like a proxy for the overall health of the market. Like there's going to be some really sick kids in the market. Like there's going to be some trash out there that's down 99%. But that doesn't give us an accurate representation of the market. The same way that looking at, the volatility of something like the NASDAQ is not going to give us an accurate look at the overall broad market because it's only looking at tech. Theoretically, looking at large market cap stocks that are profitable inside of, basically like the Dow or the S&P is going to give us a better overall gauge of the markets. So that being said, we know that we had this macro peak right here in 2008. We obviously know 2008 was, a big deal. In 2000, with the dot-com bubble burst, we kind of see, high levels in 98 and we see high levels in 2002, but we don't see like a spike top here in 2000 the same way we do in like 2008 or, on the Rona top in 2020. So while we were at elevated levels, we didn't see that same kind of spike that we did in 2008 and 2020. So it is possible we could get a situation like this where we actually don't even really penetrate the levels. We don't even get a crazy spike. We just hang out, above the neutral like heart line here. But it looks a lot like we're about to come up here and get a spike, and we may be able to use that to find like a legitimate investable or tradable bottom. So that's what we're really paying attention to on the macro for the VIX. But I think even without any drawing tools or anything, we can pretty clearly look at this and say, okay, this was a pretty clear like downtrend consolidation, and now this is a pretty clear, uptrend taking place right now. So until we see something change the uptrend, same way we just assume the downtrend is going to keep going until it doesn't, we would assume that the uptrend is going to keep going until it doesn't. So we expect volatility to pick up in these markets, and if we expect volatility to pick up, that means more likely than not, we're going to see lower prices on stocks. And that's how I use the VIX as a tool, essentially. The same way we use like Bitcoin dominance or gold silver ratio or something like that for confluence. So next we have U.S. oil. So U.S. oil took out that previous high right here, which was key. Consolidated above that level, went slightly higher, did not take out the cycle high. And then now we've seen like 3 decent days of selling. Basically wiped out like about a week's worth of price action in the markets. You guys know exactly how I feel about energy, oil in general. I think they're going much higher over time. And I do think this is the beginning of a nice uptrend. When I say the beginning, you're like, beginning? We're already up hundreds of %. Look at nat gas. Sure, I get it. But the things that have caused these prices to go parabolic are also not being corrected functionally. So even if we do see them cool off and come back down, I don't see a world where all of a sudden it's like, oh, thank God we got past that, and now energy is all cheap again. Not without bad stuff happening like a recession or a depression. So long term, if you're bullish on the world, you should be bullish on energy. If you're bullish on humanity, you should be bullish on energy. And I'm not talking about fantasy energy. I'm talking about the stuff that we use right now to heat our homes and, have electricity and live a better life than living in a cave with a fire. So that being said, if we're going to go through, essentially another form of like a technological industrial revolution type situation, which would go in with like the macro thesis behind essentially like deglobalization, essentially countries having to manufacture more of their own goods to bring back some of the resiliency in supply chain over the efficiency. So instead of making money at the cost of resiliency, we're being resilient at the cost of profits, which, the key to business obviously is finding the balance. So we obviously went way too far in the efficiency and gave up way too much resiliency. So the trend, I think, going into the future is going to be deglobalization, de-dollarization, and the retooling essentially of various economies. Even countries that are macro like exporters, things might change because demand could shift substantially if all of a sudden other countries around the world say, hey, look, China, we know we were getting all our PPE from you, but then when shit hit the fan, we couldn't really count on you and you were pretty sketchy. So in the future, we're all going to make our own PPE in-house. So, PPE, personal protective equipment, like the masks and stuff like that, just because it's relevant, why I bring that up. So you could see essentially a massive change where it doesn't benefit certain countries, the retooling, it actually hurts them or they have to pivot. But essentially, we'll see what I think is going to be like a electrical, technological, industrial, like boom going into the future. And I know it sounds crazy right now because all the outlook is so like doom and gloom and everything's terrible and wars and nukes and oh my gosh and the whole world's falling apart and all this, garbage going on right now. But the fact of the matter is macro, I am extremely bullish on humanity. I mean, it's hard not to be, right? So when it's all said and done, very, very bullish on energy prices, very bullish on all the existing energies that we have, as well as potential, energy sources going into the future. But this trade is extremely crowded. I mean, we're 6 months into the year now, basically. And, energy is the only one of the 11 sectors that has positive returns. Well, I take it back. I think utilities might be like pretty much break even right now. But essentially, it's the only one that's actually made you money. Everything else has either broke even or lost you money pretty much. So everybody's in this trade right now. All pretty much every asset class, every market, everything out there is just getting wrecked. So everybody is on the one thing that's doing good right now, in my opinion. And I think that we're actually coming to like a short-term top. Now, it's still a little early to call. I'm not going to sit here and call the top on oil and say this was it. Obviously, we nailed this one perfectly. But I really did think the way this was shaping out that we were actually probably going to break down. So it is very, very possible that we have our high here and we're going to come up and this is just going to be a lower high. And then we come back, break down, cool off. But the truth is we've gone sideways now so long that just coming back down to the bottom of the channel would actually just be a retest of a 200 exponential and simple. And I could lightweight start getting bullish from that level. I'd like to see it come down a little deeper for, selfish reasons, as well as, a technical breakdown and support level after like some short-term potential distribution taking place. But that may not be the case, but at least we'll see in time. But I really do think that the energy trade is getting a little bit crowded. Now, again, that doesn't mean that they have to just drop back down. It doesn't mean that they're not going to go higher, but I'm very, very skeptical. Whenever I'm taking profits on something at like a responsible level after a massive move, and then I start hearing like mainstream media, talking heads, influencers, whatever, YouTubers, talking about now's the time to get into the trade as I'm literally taking profits and getting out, all I could just think of is all the people that just hold my luggage, hold my baggage while I go on vacation and then I come back later and get it back from them at a fraction of the price. So every time you're, buying, somebody's selling. So just remember who's selling. So if the person selling is somebody that's probably, knows more about the market than you do, market makers, whales, good technical analysts, something like that, you should at least be questioning why this person is selling to you at these levels. And I think that that's what we're kind of seeing on oil, potentially like energy in general right now. All right, so that being said, let's look at the Dow here. So Dow Jones basically closed at the lows. It closed at the lows for the day, but it came all the way back down and closed essentially like a couple dollars off of our cycle low, which we know is a 236. So if we just put in a low, we got a pathetic bounce off of it, and then we come back down, we're at the lows again. It makes a lot of sense that we're just about to reset the days without new low timer. The count's about to go from, 14 days without a new low to 0. That's how I look at it. And the whole time we're in this downtrend, I look at it as always just a counter, and it's always just kind of counting down. The more days we go without a new low, sure, maybe it's bullish, or maybe we're just that much closer to our new low. So that being said, we obviously have nailed these moves along the way. We're very clearly in a bear market. We're under the 200 exponential and simple moving average. They're sloped to the downside. The 8 and 21 are continually, just flipping back over and going down. So very, very bearish. Obviously momentum, going to the downside, stochastics, very, very weak. And we've revisited the lows now. We know we have the 236 was the previous level that we found support. So it only makes sense at this point in time to look at the next key Fibonacci level to the downside, which is the 382. And then in some cases, depending on what chart we're looking at, we also are going to pay attention to our 2020 pre-Rona dump. And that is in some cases above the 382, in some cases below the 382. So in this case, it's obviously above the 382. So we look at that as one more stair step on the way down. And that is our next target, obviously, as the, blue box represents here. And then if we just kind of look over, and we're probably on our way there pretty quickly since we just revisited lows. And if we switch over now and take a look at our weekly time frame, and we're not going to do this on everything, I just want to look at it specifically because that is actually going to line up perfectly with our 200 exponential and simple moving average, which you guys know once we get the 821 cross right here on either a daily, weekly, or monthly, the next move we pay attention to is the retest of a 200 exponential and simple, which obviously we got right here, we got right here, we got right here, sort of a double tap. And then obviously, going all the way back to this 2008, every time we saw the 821 cross the downside, with the exception of these two little like bumps right here, we hit the 200 exponential and simple. So here we would have got faked out. We would have, gotten out of our trade or hedged ourselves, and then we would have immediately gotten back in, actually at a lower price, but essentially the same price. So it's like, okay, we protect ourselves, and then it's like, oh, we didn't need protection. So what is this? This is us driving down the road going, 70 miles an hour and saying, hey, I'm going to put on my seatbelt just in case I crash. And then you're like, oh, didn't crash, but I'm glad I wore my seatbelt anyway. And then here, put on our seatbelt, oh, didn't crash, glad I wore my seatbelt anyway. And then, here is where you put on your seatbelt and then we actually do crash. And then you're like, oh, thank God I wore my seatbelt. So that's what we're doing. We're just putting on our seatbelt when we see the 821 cross. Doesn't mean we're bearish. Doesn't mean we hate the markets. Doesn't mean, we hate humanity. Doesn't mean we don't want people to make money. It just means we're putting on our seatbelt because we don't want to get, in a crash and not be protected. So that's what we're seeing take place here. So obviously we've been, bearish on these markets for some time, called out the tops absolutely beautifully on these markets. Call it skill, call it luck, who cares? But fact of the matter is we nailed it, and we consistently have been nailing tops and bottoms. So we'll probably just do what we've been doing. But at this point in time, having revisited lows now and a fresh week and a close literally at the very lowest low, we would expect essentially we're going to threaten this low a couple dollars lower than us and then put in a new low. And it looks like basically the way we've been kind of stepping down, the amount of moves or dollar or percent changes, however you want to look at it, basically it looks like our next move is going to be right here at that slightly under 30,000 level. Looks very, very likely, very high probability. And then also we have a gap back here from November 2020 that's slightly lower than that at about 28,342. And then if we turn back on our drawing tools, we can actually see, oh look, the 200 exponential and simple moving average line up perfectly with the pre-Rona high right here, which just so happens to be our target for the next move down on the weekly. And then if we continue to the downside, we see the 382 actually lines up perfectly with the gap fill to the downside. So either of those key support levels or key levels could act as support and be a potential swing low that results in the bottom that then gives us the move back to the upside. Now, obviously, we don't want to just indiscriminately buy because we hit a support level and just assume that's the bottom. Because we hit a support level here, we went lower. We hit a support level here. It looks like we're about to go lower. So no reason to think we can't just hit the support level, get a little move back to the upside, and then go lower again. But that's why we use, stop losses and, confluence, etc. Look for those key levels for us to either put on a trade or, increase the size of our trade or get back out of a trade if we're wrong. So when we look at the monthly now, we've obviously seen the confluence on the weekly. Now when we look at the monthly, we actually have to come down. There's obviously 50 moving average, 100 moving average, all the other stuff. We look at all that stuff, whatever. But the truth is, typically those things will line up with a various other moving average on either a shorter or longer time frame. Just like if you think how many weeks are in a month, obviously, I mean, this is common sense. So, I'm not trying to talk down to you guys or whatever, but sometimes you don't think of something or don't realize something. But obviously, if you have roughly, 4 weeks in a month, well, when you're looking at a weekly chart, if you're looking at a weekly 200 moving average, and then you switch over to a monthly chart, well, that same 200 weekly moving average is going to be essentially around the same place as your 50 monthly, because you're taking the 200 week, you're dividing that by 4 because there's 4 weeks in a month, and then you're looking at the monthly. So now all of a sudden your 200 is lining up with your 50. So that's why I like to use important specific moving averages and multiples when I'm doing my personal technical analysis and trading. Because then you don't have to use 400 moving averages on your chart. Now, I have an indicator you can use, the PSAR with B pivots, which essentially has like all the key moving averages. There's a bunch of short-term moving averages, and then it has like, there's like all the fib moving averages, basically, all your fib numbers. So this one we just have like the 8 and the 21. That one has the 13, the 21, the 34, the 55, the 50, and then it has the 200s. It has all these like key moving averages that you can use. You can turn them on and off, but in the end, I like this better because it's just simpler, and you can just switch time frames and essentially see the same thing. So that's how I prefer to do it. But regardless, now we're looking at the monthly chart, and we're looking like we're about to get that 821 cross to the downside. Now we could easily come back up and retest it. We typically do that at a cross. One of two things will happen at a cross. Either the market says this is it and just goes full steam ahead, either bullish or bearish, depending on what the cross is, or the market says, I don't trust it, and then it comes back and tries to avert the cross, either bullish or bearish, and then it either does or it gets rejected. But that's our two key things to watch here is, do we just all of a sudden capitulate because we're about to get this cross and the market's bullish, or do we get a push back up, retest like 33,000? Could go either way. I mean, my inclination right now, obviously, is it looks like we're about to break down lower. So momentum, obviously, hard sell, left the bullish control zone. Stochs are accelerating to the downside, moving away from each other. So the trend is getting stronger, bearish. So it's definitely bearish, and it's becoming more bearish over time. All red histograms for literally months now, month after month after month. I don't know how anyone can be bullish in these markets when we put in clear divergence and, we're melting down right now. And then obviously red slope on the TJD, TDMACD. So again, right now is about that time where it's like, hey, we might not get in a car accident, but maybe we should have our seatbelts on. And again, that move, we had one right here where we didn't come down, which was that Rona dump. We got close to 200 exponential and simple, but we didn't make it though. And then here we have the one in 2008, which was obviously, big meltdown. And then here we have in 2000 and, it's a 2000 peak, but 2001, where again, we didn't quite make it down there. So this holds up a lot better than most assets will, but it's not unrealistic to think that we could come down here and at least get close to, if not touch the 200 exponential and simple. So, but it's definitely time to put our seatbelts on. I mean, obviously we've already been protecting ourselves for some time now. But, if you were looking at just a monthly chart, it's like, hey, it's going to be hard to deny that this thing's looking bearish pretty soon. So SPY next, again, revisiting the lows, very, very similar to the Dow Jones chart right now. You could essentially do the same technical analysis on either. The difference being that we broke down below the 236 and are consolidating below it. But again, if we just kind of zoom out here, we'll see in this case the 382 is above the high from 2020. So, on the Dow, the 382 is lower than this. So this case, we're actually going to be looking at the 382 for our next target to the downside. And then after that will be that previous high from 2020. And then again, we'll just flip over real quick on the weekly, and we can kind of see how this confluence lines up once again on the weekly, as we see that 382 comes in right around the 200 exponential simple, and then also that previous high. So that seems a very likely target. Once again, as we were just discussing, typically, when we put our seatbelt on, when we get into that crash, it comes down to 200 exponential or simple. Did get a false alarm here, false alarm, well, sort of a front run here, and then we actually see through the move. So it doesn't have to happen every time, but we know if we put our seatbelt on right before, even if the accident doesn't happen, at least we're protected. And that's what it's all about. And that's why I say, we don't have to be conservative right now, but we need to be defensive. We need to protect our capital, our principal. That way, if we do see, a serious drawdown, we don't have to spend a bunch of the move back to the upside just recovering our losses. And we've talked about this countless times as well. If you have $100 and you lose 50% of your money, you go down to $50. In order to get back up to 100 again, you have to go up 100% because you need 50 plus another 100% of 50, which is 50, to get back to 100. And it works the same way if you go up first. If you go up first, let's say you have $100 and you go up 50%, to 150, and then you go down 50%, now that 150 gets cut in half, and now you're at 75. So in order just to get back to that 100 again, you actually need, you lost 50%, you gain 50%, but you're still net negative because you're at $75. So it's very, very important. People don't realize this, but it's actually much more profitable in the long term if you can avoid losses. They're actually exponentially more important to stop from losing money than it is to actually gain money. Because on a long enough time frame, if you invest in anything with good technicals or fundamentals, you'll make money. Maybe you don't pick the best stock. Maybe you didn't pick Apple or Amazon. Maybe you, whatever. But the fact of the matter is that eventually you're going to make money. The most important thing is not losing it. If you can avoid a single 25%, 50%, or in the case of like cryptos or, trash tech stocks, like 99% downturn, and you're still like bullish long term, if you get out of the way, you get, 50% more or 100, percent more. You get double. If something goes down 50% and you could afford one Bitcoin before, now you can buy two. If something goes down 90%, instead of buying one Bitcoin, now you can buy, 10 of them. So again, very, very important to dodge these moves to the downside. And that's why, I've been very overly emphasizing the importance right now of protecting ourselves over rampant speculation, especially counter trend trading. So that being said, IXIC, NASDAQ slightly off of the lows here. But again, when we switch out to some of the longer time frames, the monthly is about to flip down. And we know this thing could get real nasty as we're way off the lows. We did already touch the weekly 200 exponential. Next target would be the 200 simple. And then again, when we start looking at those key levels, the Rona, pre-Rona high is still much lower. We're actually already at the 382 on this one, so it's much more bearish. The 0.5 is slightly lower at 10,333, and then we see 97.50 roughly as that target for the pre-Rona peak. Very much in the bearish control zone, very much a bearish chart right here, and continuing to just get nastier and nastier. All right, and then on to the old Russell. So same thing, slightly off of the lows. Actually looks a little bit better than the Dow Jones and the S&P. But overall, terrible chart. Just this little bit of a move right here, and then the pullback is what looks better. The rest of it looks like trash. We did already hit the 382 in our target. We did already hit the pre-Rona highs. So literally, if you were an owner of the Russell in January of 2020, before the dump, it went all the way back up, put in new highs, consolidated forever at those highs, and then came all the way back down, and you're right back to that same level again. Very, very bad. Wiped out massive amounts of gains. And then weekly, we are retesting already 200 exponential and simple. We have those key levels. It's important to note here that in 2018, we put in a high. In 2020, the pre-Rona dump, we did not put in a new all-time high. So this was already trash. It was trash before that even happened. And then if we just look at the monthly real quick as well, again, we'll see the 821 cross has already taken place. We don't always come down to 200 exponential when we get the cross. Sometimes we overshoot it. Sometimes we, don't get in the car accident. Sometimes we hit it perfectly. We don't know what's going to happen this time, but I suspect that, now that 821 cross has taken place, that we'll at least get some follow through. The real question is, do we hold up at like 1600 or, do we end up back down here at like 1260? Again, terrible looking chart right here. All red histograms, red slope line, hard sell signal, left the bullish control zone, Stokes angle to the downside, and powerfully accelerating. We see no signs of a bottom at all. And people always ask me again about, how do you pick bottoms, how do you pick tops, leading indicators, etc. Here's the knife right here on the monthly for the Russell, and look at the absolute low. It literally tells you the absolute low in the market. And then again, we see the peak or trough, I should say, right here in 2016, and it actually prints the knife stab down here, at basically in advance 1 month before the lows, and the next month, even though it goes slightly lower, actually like closes at the same level, and then we see a continuation. So if you're looking for something that's going to help you to pick bottoms, and oftentimes gives you the exact candle, if not, it'll tell you one candle before, or even sometimes we'll get a divergent print on the knife itself. You'll see two big peaks and, bullish or bearish divergence. Here we don't see that, but sometimes you will. Absolutely beautiful tool, and sometimes people forget about it. It's just kind of creeping there with our stochastics in the background. But the truth is, the Stokes are great and everything, but the knife is what makes this indicator so amazing. So if you're not really breaking down and looking at the knife and seeing what's going on there, and you're just kind of focusing on the stochastics, you're missing out. You're missing out, because that knife is absolutely amazing. Absolutely beautiful how well it works coupled with that. So That being said, enough floating my own boat. You guys know, obviously, I love these indicators. You can get access to them if you want to join the trade group. You guys know about all that good stuff. So XLE, energy. So we see the 4 major indexes basically threatening the lows, probably going to put in new lows, building momentum to the downside. So that being said, anything we look at inside of, the various sectors or cryptos or whatever, probably going to be telling us, a varying degree of the same thing. It's either going to be looking bad or be looking, worse. But XLE obviously is the, one outlier, as this is essentially, the energy sector, which we know is the one of 11 essentially that's doing well right now. So we have to watch out for this potentially putting in a peak the same way we talked about on oil, as we are getting the hard sell signal and leaving the bullish control zone. We haven't technically left it yet. We're still inside of it, but we have the hard sell. So when we come down here, if we do leave it, that's basically telling us we're probably going to get some follow through and a deeper retracement. Maybe back to like low 80s, possibly lower. It depends how nasty it gets. But we've gone absolutely parabolic. We know on the weekly chart, we've confirmed into a bull trend above the 200 exponential and simple. We know the reversion to the mean play, or the retest of fair value, aka the retest of a 200 exponential and simple. Very, very likely when you go into a bull trend. The same way you test it as resistance, it gets rejected, and then we break through it. Then we test it as support, it gets rejected. Lower prices get rejected here. Higher prices get rejected here at the moving average. That's our swing. That's our pivot. So when we come up here, eventually when this runs out of steam, we expect a pullback. Depending on how bullish people are on energy at the time is how deep this goes. If people are still really, really bullish, maybe we get a shallow retrace and it only comes down to like 70. If people are really, really bearish, maybe it comes all the way back down to 58. But that would be our reversion to the mean play. The reversion or return to fair value. And then at that point in time, the market can decide, okay, now that we're fair valued again, do we want to go up? Does this hold support? Do we reject lower prices and then continue higher? Or do we come down to it? It doesn't hold support. We come below it, retest it, and then it rejects us for higher prices, and then we go lower. I think we come back down, retest it, we front run it. I don't think we get back down to the 200 exponential and simple. I think we front run it, but get a pretty deep, fast recession, and then it immediately V's and just shoots back to the upside. Now, when I say immediately, we could be looking at like a weekly or monthly chart. So we could be talking about literally like a 2-month to 6-month period or something like that. When we look at the monthly on XLE, though, obviously extremely, extremely bullish. Taking out these 2 levels right here was very, very key. We consolidated there. And then obviously this was the market saying confirm breakout, explosion to the upside. And that's essentially what we're looking for in things like the DXY and TNX, is when the market finally agrees and says, okay, confirm breakout, that's when we get that launch, that explosion. But the next key level to the upside we're watching is 100. That is obviously our target on XLE. The question is, what happens in the meantime? Do we come back down lower first? We're obviously at extremely high levels here. We still got a little ways to run. We're not seeing some crazy peak spike on the knife or anything like that either. We have all green histograms, slope line, blue, and beautiful. So as far as we're concerned right now, we're not trying to pick like a macro top on this by any means. This is arguably a bearish candle. It's not like super bearish, but it's enough to pay attention to. Basically we had a push up and the market started to reject those prices. We'll see how it ends though. If this keeps selling off and we close lower, it's going to look like a bearish candle. If we move back up here and it just leaves a little wick behind to the upside, it's going to look fine and we probably just continue to see, bullish continuation. But right now, looking a little bit tired right here. So everybody's saying, oh, now's the time, pile in, all in on oil, all in on energy. Yeah, I don't think now's the time. The time was a while ago when nobody was saying it except for us, and a couple other select analysts. So transportation, XTN, again, new lows, new low close, absolutely terrible. Looks like it's on track for the macro 236 or our short-term 382. Which also, again, lines up perfectly with our, in this case, it's the 2018 high, only because this is trash like the Russell, and it didn't put in a new 2020 high. But essentially, that would be us running down to roughly like 66.75, which we're like almost there at this point in time. It's like 10% more. So, but what happens after that? Well, probably find some temporary support and then bounce back up here, put in another low high, and then probably go lower again. And then we can start looking at like the 0.5 or something. But overall, just still looks bad. XLF, obviously financials, new lows. Absolutely terrible. I mean, again, you got to be an absolute moron to look at what's happening on the macro scene right now, fundamentally and technically, and go, financial sector is a good investment right now because of, because there's no reason. There's not. You can argue, oh, mortgage or percentage rates are going up and they loan people money, so they're going to do good. But no, it's not how it works. We've talked about this countless times, and the market is just proving us right in real time, which is great. Because then we don't have to just sit here and say, one day we'll be right. We don't have to Peter Schiff it and be like, look, guys, we're right. It just hasn't happened yet. So we're going to be right eventually. Just hang on for another decade. And I like Peter Schiff, but I do like busting his chops. But let's be real. When the market literally validates what we've been saying within hours, days, or even, weeks, it definitely gives us a little more credibility towards, we've got our thumb on the pulse of this market. So very, very bearish right now. Look like a retest back up, a rejection off of key support, and then we're putting in new lows. Days without new lows on the financial sector, 0. Reset the count. So again, looks like we're just going to keep going lower. XLB. So healthcare, basically got a pretty pathetic, right shoulder or something like that. Now, here's our scenarios right now. Is it possible we find support here, come back up, and then we actually put in like a real clean right shoulder, and then we come all the way back down, and then we break? Sure. Could we have a bullish scenario where we just find support and then skyrocket to the moon? Sure. Could we have a much more bearish scenario where now we just break down, and while it's not like a pretty pattern, it's essentially like some form of head and shoulders distribution type pattern taking place? Sure. And it looks like that's probably what's going to happen. Now, we haven't technically closed a new low yet because we have this gap down, open and then pop up here. But realistically, if we lose the support level we're at right now, I expect this to go much lower. So when we start paying attention to key fib levels, first target would be the 236 at 122, 73. And then obviously we have 382 much lower. And then, the yellow line here represents our 2020 highs, which again is much lower. So still a little ways to go on this, but it does very much look like healthcare going through a macro distribution pattern right now. Now, we know this is a safety trade. This is where people run to protect their capital in, volatile times. So if you run somewhere to protect yourself and then all of a sudden that protection isn't working anymore, it's possible we see a violent move in some of these safety sectors, quote unquote. Some of these it's basically like the textbook recession play. It's like, oh, things are getting bad. There's possibly a recession on the horizon. Where do we put our money at? And it's like, oh, we can go to healthcare because people will always need healthcare no matter how poor they are. We can go to utilities because people will always need utilities no matter how poor they are, et cetera, et cetera, et cetera. So if everybody runs here to be safe, the same way everybody runs to energy to make money, and then all of a sudden the trade starts to flip and this starts to sell off, we could essentially see like a very violent move in this because hold up a lot better than most things. So when it does break down, it would break down with, more intensity, potentially. Or maybe it just goes to the moon, but probably not. So XLU got that violent move down back inside of our resistance support levels now. And you guys know, as long as we're between these two yellow lines, we're essentially just range bound. So it looks like we're going to retest the 200 exponential and simple while we're down here. We got the hard sell. This was no surprise or anything. Obviously just put in a lower high. So the thing we're watching now, what we don't want to see if you're bullish on utilities or you're looking for this as a safety play, we do not want to take out this low right here. Because as soon as we take out that low, we then have a high, low, lower high, lower low, start of a downtrend, and then we would expect continuation back to the bottom of the range. XLP, consumer staples. I mean, consumer's obviously strong, so this should probably just rocket shift to the moon tomorrow because everybody's good. People are making tons and tons of money. Nobody really cares about inflation. Macro, everything is good, and I would say consumer confidence probably at or around all-time highs. So, judging by what the media is telling us about consumers, I mean, this thing is just literally getting to rocket ship like any minute now. But in reality, obviously the consumer's not strong. The consumer's trash. They have record credit card debt. The inflation has far outpaced any, wage gains that people have had. And we're clearly about to go into, or realistically, we're already in a recession. Let's be real. They have revised the GDP from we're probably going to have 3% GDP growth. We're probably going to have 2% GDP growth. We're probably going to have 0.9% GDP growth. So how long until we get the real data, or the next revision is like, we're probably going to have 0.4 GDP growth. And then let's be real. We have 1 quarter, negative GDP growth. So in all reality, we're 50% of the way there. And the truth is, we're actually just already in a recession. We just haven't confirmed it yet. I mean, in all reality, you can look at energy prices and say, if we're not already in a recession technically right now, we're going into one, because realistically, we talk about all the time, the best cure for higher prices is higher prices, because the higher the prices go up, the less demand goes up, because of the, price demand curve, essentially. Like if something goes up, the more it gets expensive, and we can look at it in extremes. If it was currently, let's say for a can of, Coca-Cola, if it was currently, 50 cents, and then it goes up to $1, there's a certain amount of people that are no longer going to buy Coca-Cola. And then if it goes up to, $2 after that, an even larger amount of people are going to not buy Coca-Cola. And then eventually there's so many people that stop buying it that the company, or, supply and demand dynamics lower the prices back to where there's like, a balance between that supply and the demand. And part of the problem with everything right now is the supply demand dynamic is so messed up, and there's so many like central planners trying to essentially manipulate everything, and there's so much lag, and they're so bad at their jobs, that we're just going to see these crazy wild swings of like volatility and just insane inflation, then deflation, massively expensive prices, then extremely cheap prices, just crazy swings, which is great. That's what we love, as macro like traders. But when it's all said and done, this consumer demand, I mean, we know what's going to happen right here. Every dollar that a consumer would normally be purchasing junk with, whatever, tennis shoes, movie tickets, whatever it is that you're going to spend like your discretionary income on. If the things you have to buy or pay for, like rent, fuel, and people fuel, aka food, if those 3 things are going up, every dollar they go up eats into your ability to spend on your new tennis shoes, or, a new car, or, a new jacket, or whatever it is you want to buy. So we know for a fact that it kills purchasing power of consumers because they have less discretionary income. So in all reality, as long as we see this inflation taking place, it's very unlikely that we're going to see consumer strong, earnings strong, positive revisions, and like rosy outlook going into the future. The only reason consumer staples stays stronger, as opposed to like, for instance, like consumer discretionary, is that's where the demand is shifting from. Because consumer discretionary is all that extra good stuff that people like to buy, but they don't need. Consumer staples are the important things that people will not stop buying. Maybe they'll buy less, maybe they'll buy off brands, but they need them. So this will hold up better, but may not hold up well, especially, if the consumer does really bad, we'll probably see consumer discretionary get crushed, but consumer staples will do bad, but not as bad, because there's a lot more of that like reliable, consistent necessity of demand. So that being said, we're at a key level right now. We already put in this low right here. We don't want to put in a lower low, and we definitely don't want to go below our 68 level. That's a very, very key support. It was resistance in 2020, and that would potentially act as, this macro support, which it has multiple times. So again, it looks like we're headed down to that level. We're at a key support now. If we break down from here, which again, looking at this chart, this is one of the few sectors right now that has not confirmed into a bear market already. So even though we broke down below the 200 exponential and simple, we then got a reversion of the mean play, which is a retest of fair value, and then we got rejected. It looks like we're going to go lower, and then the longer we spend under the 200 exponential and simple, just a matter of time before they flip. It looks like the 200 exponential has already flipped red. 200 simple is basically flat. So we're probably days away from that flipping red as well. And, we had a quick little scare right here, and then that was our retest. So now after the rejection, we would expect if this flips, we're confirming into a bear market on consumer staples. And then at that point in time, we expect a lower low and consistent lower prices. So we have a high, a low, a lower high. We expect a lower low, come back up, another lower high, and then keep going back down. And obviously we have some key levels to look at, somewhere around like that 68 or so. But This is holding up much better than most other charts are, but it's not looking good. It's starting to not look good. And then XLRE, real estate. So again, we can see the difference here. This was the initial breakdown below 200 exponential and simple. This was a pretty bullish move back up to a lower high. This was our reversion of the mean play, and we just overshot. And then we confirmed to the downside, confirmed into a bear market, and then again, we just come down, put in another lower low. So now we have a high, a low, a lower high, a lower low, clearly in a downtrend. At some point in time, we expect another retest of a 200 exponential and simple. Don't know when that's going to be. Don't know what it's going to look like, but it probably will have something to do with a key support level. So there was an opportunity here off of this key support level in yellow to have that push up and get the reversion of the mean play. But it failed. It was a weak push back up. It got stopped by this level of resistance right here. You know, these two little bottoms right there, that acted as resistance, was previously support. That's our SR flip. The same way the 200 exponential and simple could have done that. Instead, just this random horizontal support did it. And it makes the chart look much weaker because instead of coming all the way back up to 200 exponential and simple, we get rejected and then we put in a new low. So eventually we'll get the reversion to the mean play, but it's probably going to be from much lower prices. And the fact that we didn't get there off the initial bounce right here, and now we're putting in a new low, seems much more realistic. We come down to the 382, we complete this beautiful trade setup this was from a while ago at this point in time. And then once we get back down here to like 39 at that 382, then, you know, depending on how long that takes and what the chart looks like, you know, the moving averages will continue down here. Maybe they're down here closer to like the 236, and then maybe we bounce the 382 all the way back up to the 236. Maybe it's just like somewhere around here, but realistically, that's sort of like the general posture that we see taking place. But very clearly have a macro, you know, head and shoulders taking place right here. And then, you know, obviously we set a very nice trade setup right here. The first portion of the trade setup was the retest of the neckline, which played out, and then the break of the neckline, retest of the break of the neckline, aka that resistance, and then now we're putting in lower prices. So we're on our way, almost done with the second trade setup at this point in time as well. So it was like 20% total, and I think we're at like 15% or 16% or something now. So nice trade setup playing out right here. And you know, we did this in real time and everything, and discussed the two opportunities right here, where essentially this comes down, breaks below the 821, we get the cross, and then we want to be short, or it finds support and then moves to the top, and then we hit the previous all-time high. And then at that point in time, the only thing we're worried about is essentially just like a double top or like a short squeeze or a throw over. But realistically, you know, once we break through that previous all-time high, there's a very high likelihood, you know, that we essentially get that blue sky breakout and go much higher. Obviously, the trade setup we put in play, you know, and my reasoning behind it, you know, I went over it a bunch of times, but, you know, we very clearly had some signals. This was a peak here. This was a higher peak right here. And then if we line those up, this was our high right here. This was our lower high right here, was the initial one. So we basically have bearish divergence right here when this was looking like it was going to roll over. And then with the 821 cross on top of that, it looked like a beautiful trade setup for a short. And, you know, clearly, I mean, worked out beautifully. So, all right. So there is our, you know, did a little bit of, you know, a little in-depth on a couple important things here. We can kind of speed through everything else a little bit quicker, I think. Try to keep these relatively short. We're already at about an hour. Yeah, I probably spent too much time on that already. So we'll keep these pretty quick. So DXY, obviously threatening the high. Looks like it's going much, much higher. Still very, very strong here. Have to be careful that the slope line flipped over blue right here, and we have the histogram coming from the bottom. Oftentimes what happens is when you hit that slope line, it's already turned blue, you get rejected and go down. So if we're about to put in a new high right here, and then we get rejected, this is going to be some pretty clear bearish divergence potentially developing and could lead to our top. So I'm not saying it has to happen. We could easily just cross above this and go to the upside. But if we get rejected at the blue slope line right here on the TDMACD, that is literally like one of the most reliable divergence rejection signals. So if we don't just continue ripping through here and just go to new all-time highs or new cycle highs and keep going, there's a very, very high possibility that we actually get rejected, put in bearish divergence, and we could see a deep correction on the dollar. Maybe like, you know, obviously deeper than the 100 level, maybe down to 200 exponential and simple. Still very, very bullish on this. Not saying that has to happen. You know, long, short, medium term, still very bullish on the DXY. But this right here is a warning sign. This is a yellow flash right here saying, hey, check both ways before entering the intersection because there may be a cement truck coming at 100 miles per hour, you know, in your blind spot. So So Tesla next. So we recently got an announcement. I think officially it was Friday that they are going to do another stock split. So I'm not sure the exact dates on that. I honestly don't even know what the reasoning is behind that, but whatever. 3-to-1 stock split. Currently trading at about $700. I mean, I would imagine Elon's probably trying to do it to pump up the value. I really don't know. I mean, $700 stock is not that expensive. 3-to-1 split, is going to take it down to basically like $233 roughly. I mean, it might be at 600 by the time the split happens anyway, so maybe it's 200. But, let's say it takes it down to 233. I don't think a lot of people that couldn't buy a stock at 700 are like, oh, thank God, now it's only 233, so I can pick one up. I really don't think that makes a big difference. If it was like Amazon where you're at 2,000 and then you go to 100, or if it was something like Google that was talking about doing a, stock split, it would make a lot more sense than Tesla right here. I'm really not sure what the purpose of it is, but it could be a potential bullish catalyst. Announcing a stock split right as you confirm into a bear market seems like desperation to me. I've talked about this multiple times before, though. Obviously, Elon Musk is like the richest man alive. So I find it hard to believe that he doesn't have extremely, extremely, talented, intelligent people, working for him in all factors, including technical analysts. And, I've actually proved in the past that Elon is using technical analysis because, and, you can say whatever, oh, yeah, I'm sure Elon's using technical analysis. Oh, that makes sense. Oh. Well, I mean, it's like one of the richest, smartest people alive. So he probably is, or he probably has somebody doing it for him. But this breakout of this pattern right here, the move up, and then the technical, measure move to the upside took us exactly up to key levels, which was the 1.618 Fibonacci extension from the high to the low. And that just so happened to be right here where Elon sold his stock at. So he just so happened to sell a ton of stock at the 1.618 Fibonacci extension after an exact measure move breakout of a pattern that was developing and what amounted to, arguably, is it cause and effect, which came first, chicken or the egg? Did we put in a top on Tesla because Elon sold, or did Elon sell the top? Whatever. I mean, I would say probably we put in the top because Elon sold, because if the guy who owns the most of it and, is the brains behind the company is selling publicly, probably like does a little work on people's sentiment. That being said, I don't think it's a coincidence that he just randomly sold the 1.618 Fibonacci extension perfectly, publicly, and just happened to like get lucky. But I could be wrong. Maybe it was just a complete fluke, random accident, and just a complete surprise. And it just so happened that Elon picked the exact perfect level to sell the 1.618 Fibonacci extension out of luck. That's probably it, though. It's probably has nothing to do with technicals. So that being said, I'm not great at sarcasm, but hopefully you guys are picking up on it. You're picking up what I'm putting down. So that being said, we don't know what's going to happen right now. We're looking at this potential inverted head and shoulders. It looks weak now. It looks like we're about to break down from it. Still some possibility. The real thing to look is, if we can get above 775, there is potential for a bullish catalyst. And again, we have now officially confirmed bear market and we're below 200 exponential and simple. So at some point in time, we do expect a bear market rally retest of the 200 exponential and simple, which is essentially what this trade setup is that we're looking at right here. For like some quick little 30, I mean, depending where you get the entry at, 20 to 35% scalp. But we have to see where it's going to come from. We're looking for key things, bullish divergence. We're looking for confluence between our indicators, oscillators, et cetera, all that good stuff. So paying close attention to this, there are definitely some signs. But the fact that Elon perfectly sells the 1.618 and then Tesla announces a stock split on, I believe it was on Friday, as we literally confirm into a bear market. Now, granted, not everyone uses 200 exponential or simple. Not everyone uses the slope line. This is my method of determining a bear market, but not everybody uses 1.618 Fibonacci extensions either. So, maybe I'm Elon's guy. Maybe it's just a complete fluke. I mean, full disclosure, I'm obviously not Elon's guy. I'm just saying we just so happen to be doing the same thing. So as far as I'm concerned right now, Elon Musk and Tesla are clearly doing technical analysis and making decisions based on that. Sells the high right here, confirms into a bear market, announces a stock split. Does it work? And create a bullish catalyst to get that retest? It's possible. We'll see. Looks like it's rolling over. Looks like it wants to go lower, but see what happens in time. But Elon and his boys are definitely doing some TA. Let's be real. ARKK looking like trash. Completely melting down. I'm about to just take this off the list. At least for now. I mean, until we see some kind of like potential. I mean, it's just, we just get on every day and we're like, oh, look, it's down again. Oh, look, Kathy Wood still sucks at her job. All right, cool. NVIDIA is next. So NVIDIA revisiting the lows, not quite there yet. We were talking about some potential for support right here for a bullish scalp. Does not look like it's going to be the case. We'll have to see. The key area to watch now is, do we take out that low? If we take out the low, you know, we likely just continue on down lower. We obviously have a high, a low, a lower high, a lower low. You know, didn't really get much of a push up right here. Again, looking for a potential scalp for the reversion to the mean play. You know, and that could, maybe that's turnaround Tuesday. Maybe it's next month. Who knows? But we're definitely watching for it. And as I'm glancing over at my other screens, I'm seeing Bitcoin is just melting down. I mean, I'm shocked. All right, so we'll get to that crypto here in a minute. All right, so Apple next. Apple is not looking good right here. So we have closed down back at the lows again. We talked about this level being essentially the invalidation level for that potential. What we were looking for was Apple to come back down here and find support and then take an entry off that 140 level. Instead, what happened is we closed aggressively to the downside. We then gapped down to that level, and then immediately it sold off to, you know, what would have been the stop loss for this trade. So, you know, arguably a new low or same low. It's at the level we want. It's perfectly at the 236, but, you know, the story changed. So we don't want to enter into the trade, obviously, when it gaps down and just melts down past our potential entry and then stops at where we would potentially have our stop loss. Now, there is an argument to be made that the real trade right now is to just trade the 236 bounce. You know, and that basically just gives us a juicier version of the reversion to the mean trade. So essentially, you know, you run a tight stop loss, which was already like 2.7%. So that's basically, you know, if it continues down right here, but then that reversion to the mean play is basically just a retest of a 200 exponential or simple, just from a lower price. So, you know, somewhere around like 15% with like a 3% stop loss, 5-to-1 risk reward. We'll see. I mean, realistically though, you know, you could just take the entry right here with an even tighter stop than that. But I mean, 2% stop loss, not really a big deal. So it does look like momentum's building to the downside. I'm not bullish on these charts at all. I know we have a bunch of like bullish setups on a couple of these, or not a bunch, but you know, I know we've been putting some bullish setups. We obviously have some bearish setups. We obviously have, you know, trades and whatnot in play as well. But the important thing to notice here is the bullish trade we're looking for, or the trade setups that we're posting right here, may have already happened, may not happen anytime soon. But essentially what they are is they're the last good bullish trade going into a bear market, because all they are is the reversion of the mean trade. They're that same trade we were talking about when we break down from fair value, overvalue, fair value, undervalue. So at some point in time, we expect to come back to fair value. And that's where we want to take profits and get out of our trade. But realistically, anybody that bought here thinking, oh, we're at fair value, I'm going to buy support, and then we break down from support, as soon as we come back up to support, those people go from net buyers at support to net sellers at resistance, just trying to get even. Because when you're in a bull market, you want to make money. When you're in a bear market, you just don't want to lose money. So when you take an entry and then the market goes against you, you're immediately looking to get back out of that position at break even, because nobody likes to be a loser. I mean, some people, I think, actually do enjoy being losers, but they probably have some issues. So Google, well off the lows right here, but arguably just because it melted down so hard, I don't know. Clearly came back up, retested 236 and got rejected. It looks like it wants to come back down here to the 382. Oh, did I miss that? Did anybody know about this? Am I just... I mean, I swear to you on everything, when I literally said Google should do a 20-to-1 stock split, I kid you not, I had no idea that that was already announced. So I don't know when they announced this, but apparently Google is doing a 20-to-1 stock split on the 18th of July. So that's great. We just talked about that, how I think that's genius. Going from $2,223 a stock to, you know, $111. makes this a lot more attainable. And again, we talked about the fractional, ownership, etc., and why it really shouldn't matter. You're basically just taking the same pie and you're cutting it up into, 20 pieces instead of just having one pie. You have 20 pieces of pie, but you still have just one pie. So arguably, it shouldn't make much difference, but we know statistically that typically going into a stock split, you do see a run up. So I'm really curious though when that was announced. So if anybody knows, let me know. Otherwise, I'll look into it just because I am curious. Abu did confirm into a bear market. Doesn't look particularly great. We front ran the 382 slightly at like $2,000. Looks better than most things that look bad, but still looks bad, but not quite as bad. So, yeah. Very clearly in a bear market. Potential for that reversion of the mean retest. And I think probably when this one happens, we don't know when it's going to happen from or where it's going to happen from or anything like that. But let's just hypothetically say we do get down to the 382 and then we have the push up. When we get the push up, we probably get rejected at the 236 or potentially get that move back up to this white line support, which would line up with the 200 exponential and simple depending on when we get there. So that's like the potential trade setup we would be looking for in a scenario like that. And just generically with like a 5% stop loss, 26% move to the upside, 5-to-1 risk reward ratio, counter trend trade. We're in a bear market, but it's a bullish trade. But the risk reward is high enough that even with the lower than average probability of success, the risk reward more than makes up for, the failure rate. But clearly position sizing is key as well. So Amazon, so we talked about the potential bullishness of the split and how that could lead to like a bullish catalyst. And what really happened here is, we basically ran up to the split and then the split happened and then we just melted straight back down. So arguably this was the bullish catalyst that let it come off the lows. But it was just pathetic. I really thought we were going to get much more of like a push to like the equivalence of 135 at this point. But it was like, 2,700. Yeah, I mean, these things look rough. Did I just delete this chart or something? Okay. Apparently there's no drawing tools on here. We didn't draw anything on Amazon ever. All right, Microsoft next. Obviously head and shoulders playing out. We got the majority of the measure move, came back down, slightly front ran the 382, very, very slightly. But, obviously that's why we use the blue box. We'll put like, entry slightly higher off that because we expect a little margin of error one way or the other. Either like a slight front run or undershoot or a slight, overshoot, etc. But that being said, back down here at the lows, it looks like we're coming down to the 382. So we front ran a little bit. We got the bounce. We retested 236. It failed. Looks like we're going to come down to the 382. When we get here, though, normally we would bounce to 382 and then we would retest the 236. Arguably, it already happened. So, and it was weak. But the truth is, and again, don't want to get overly bullish. I'm still very, very bearish on these markets. They look like full-on trash, and they closed at the lows on Friday. So we probably see continuation. But there's going to be, at some point in time, potential for some kind of trade like this, which is going to be the reversion to the mean trade, that essentially failed right here. It underperformed, came down, maybe front ran, underperformed. So maybe we get the clean test right here and then actually overperforms or like performs at all. 20% upside, 3.4% downsides, 5.6-to-1 risk reward ratio from the 382. We'll see what it looks like when it gets down there. But again, just practicing putting like these trade setups in play and then seeing how they play out from key levels can help build your confidence as well, because you can see how the chart actually develops. So I encourage you all to look at, either your own charts or do the same thing I'm doing or look at other assets that I'm not looking at and start trying to use these same methods to essentially do what I'm doing and then see how it plays out into the future, whether you're actually trading, whether you are, paper trading, whatever, it doesn't matter. But you're going to learn a lot more from like the actual implementation and seeing how, okay, I picked this level because of the moving average and it didn't work. I picked this level because of the Fibonacci and it worked perfect. I picked this level as my target and we didn't make this a top and now we're right back at the entry and I never moved my stop loss up. So I just turned a winning trade into a break even or possibly neutral trade. So you learn these little things, you see these key levels, you see what's working, and then you just keep sharpening, until eventually you've got it down and, consistent. And then you don't even have to watch me anymore. You just do whatever you want. because you'll just be better. Be better than enough people at that point in time that you don't have to be the best. You're just not going to be one of the losers. So Microsoft, we'll see what happens here, but there's definitely some potential. A lot of these stronger, big tech names want to have this reversion to the mean play. The only thing that throws me off is we just had these underperforming moves. So we'll have to see how it plays out. But, we've laid out a couple of potential scenarios there. So Walmart back at the lows, still looks like trash. Target back at the lows, still looks like trash. I fully expect these things to melt down. We did talk about this, I think, on stream about the Target daily gap back here all the way from 2020 in August. So we have a gap slightly below us. We're basically at the gap now, and it goes down to 138. So the next target to the downside, I think, is going to be that 138 gap fill. And then when we look at that for our confluence, that lines up with our macro 618 retrace, and then our internal 618 retrace, and then the macro 382 as well. And when I say that, the wave 4 to wave 5 potential right here, that's our 618 retracement that we're looking at. And then the bottom of 0, wave 1, wave 3, and wave 5, that's our macro fib retracement. And we already blew through the 236. So the 382 lines up with the 618. So this to me has a lot of confluence and is a key level. And then on top of that, we have the gap fill as well. So this could be a really nice trade from this area. But first, we need to see, the same way with this last pop and being able to call it and saying everything was at support. We're expecting a bullish bounce. All assets are at various different levels, but everything's at support. Everything looks exhausted. We're seeing bullish divergence all over the place. And then we got that last move. That's the same thing we need to see for a move like this to play out. We need to see everything getting to key support, getting exhausted. I don't think just target comes down here, hits its I was about to say target hits its target, but how about target hits our key area of interest and then just shoots to the upside while everything else continues to melt down? Don't think that's going to happen. In order for these bullish rallies to happen, they need to happen together. But like, for instance, target already had the reversion of the mean play right here and then just capitulated. Some of the other ones are waiting to have that reversion of the mean play. So maybe our target support move right here lines up with some of those other reversion to the mean plays, retest of a 200 exponential and simple on other assets. But this would be like roughly a 25% move with, essentially, I would think we definitely don't want to violate that. Somewhere around like a 7.5% stop loss. So you have to be a little bit, you could run an even tighter stop than that, but that's where I would look for. If we close the daily below the top of the 3, I would just want to look at the next level for support. But realistically, that's still like a 3.5 to 1 risk reward ratio. So it's not amazing, but it's enough to be profitable even with a, less than ideal probability of success. All right, let's look at our cryptos. Crypto Connect. Let me jump over in the chat real quick. J Hoff, hope you are learning something, man. Parag says, can we cover VXTR, DraftKings, PayPal, or CF at the end of the stream? Hey, yeah, we'll have to do it next time on Wednesday. I halfway forgot and halfway was just like lazy and didn't do like the updates and everything. And for whatever reason, TradingView is still acting a fool. So it wouldn't let me like pull up tickers. So for the group members that ask for a ticker, I'll do some charts in the group and then I'll do those on Wednesday. And then obviously for you as well, brother, I will do those on Wednesday. On SPY, can you explain how you identified when to go risk off? And then it was announced in April of stock split for Google. Was it really in April? Damn, how did I miss that? That's crazy. I definitely heard about Amazon, but I had no idea that there was a stock split coming up. That's weird. And I didn't notice the little thing on the chart either, huh? Okay, so yeah, I'll just explain on Bitcoin how I know when to go risk off. Because I use the same strategy on everything. So, the key decision for me is what we talk about all the time. So, and if you're just tuning in, remember, none of this financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. If you want access to the Jewel Thief, this one right here, and then also the TJD Master, those are reserved specifically for group members who show their support. So if you want to get a hold of them, you can contact me. That being said, you can do the same thing without these indicators. You don't need them. but they just make it easy. They basically take my trading strategy and then turn them into like a visual, easy tool. And then obviously TJD, TDMACD, the old version of Joule Thief, and like I think like 12 other indicators, including a different moving average indicator, the PSAR with B pivots, all available for free. So, you don't have to show any support, but you don't get the good stuff. But that being said, this essentially encompasses my strategy right here. So the key things that we do are we look for, are we in a bull market or are we in a bear market? So depending on what time frame you're on, here on the daily, once we're above the 200 exponential and simple and they're both blue, we're in a bull market. So as long as these two lines are blue, we're bullish. And then when we look for exhaustion, here the 200 exponential crosses red, but we're still bullish because the 200 simple is blue. And the angle of the 200 simple, it's very clear that it wasn't going to be flipping down anytime soon because it was still aggressively angled to the upside. But when we see the 200 simple, the light blue, cross above the 200 exponential, that tells us we probably get one more push to the upside, most likely a new all-time high, and then the trend is over. So we'll look for bearish divergence, which obviously played out perfectly. So, basically the market was our bitch, which is great. That's what we want, obviously. And then we come back down after that high and we threaten the 200 exponential and simple again. And then here we see, basically the way these are coded is once the slope of the line flips to negative, it changes the color to red or pink respectively. When the slope of the line is bright blue or, kind of faded blue, that means the slope is to the upside. When the slope of the line is to the downside, it flips it to pink and red. So essentially what we're doing is we're using the 200 exponential and simple to determine fair value. Are we overvalued? Are we fair valued? Or are we undervalued? Determines our relationship to those moving averages. So once we're under the 200 exponential and simple and the slopes to the downside, this is a bear market. So this was essentially bull market, bear market right here. So I think I have them on this chart highlighted already, right? Yeah, okay, kind of. All right, so essentially what we have right here, don't just ignore like the big green box. This is when we flipped into a bull market. That was our buy. This is, here we have the 200 exponential flips red, but the 200 simple is still bullish. We come up here, we don't put in a new all-time high, but we see the trend is putting in exhaustion right there. And then here we break down below the 200 exponential and simple, the slope flips red. This was right before Rona when everybody, literally I called the capitulation move on the stock market ahead of time, as well as Bitcoin, to within a couple of percent. It was like a 30 to 50% move down, and I hit targets within like less than 1%. So for all the people that said this was a black swan event, there's no way anyone could have seen it coming. It's impossible to have traded that. No one could have gotten out of the way. We nailed it, and there's proof because you can just watch the videos. That being said, when we had this capitulation move, right before that, we had confirmed into a bear market right here when the 200 exponential and simple had flipped. So you should have been exited out of crypto at 8,000 if you weren't already exited out. I think I took most of my profits at it was close to like 13,000, I think. It was pretty ridiculous. But that being said, once we broke down from those levels and then we hit key levels after that, then we're looking for the bull market to resume. So here we see a 200 exponential and simple flip back blue again. So that was beginning of the bear market or bull market. From that point on, we basically, using a strategy, we know the bull market's on at 9,500, let's say. So at 9,500, you should have been long on this asset class. And then again, no trades in between. You don't have to do anything right up until, I'm going to turn off the drawing tools, right? Right up until that transition happens right here. So if you bought at 9,500, you literally did nothing, and then you just sold once the 200 exponential and simple flip bearish, or we confirmed into a bear market. You bought at 9,500, you sold at 47,645. So you made 38,000 per Bitcoin, just by using that simple strategy, just buying when they're blue, selling when they're red. So that's the easiest way to just sum it up. And then inside of that, the way my strategy works further is I use these two other moving averages, the 8 and the 21. And instead of using the slope of them, because here you see the slope is down, but they don't flip red until they actually cross. So these are coded differently. When the 8 crosses below the 21, these flip red and pink respectively. So that's for like scalping on the same time frame. So obviously now we know the trend is bullish because it's blue. So we want to trade with the trend, which means we want to take bullish trades. But when the 821 flipped to the downside, we know we're going into a retracement. So we want to either hedge ourselves or, protect ourselves essentially one way or the other, whether we're like shorting against our spot position, whether we're just selling and repurchasing later, or, whatever you're doing for protection. Once that 821 crosses, we get out of the trade short term or we cover ourselves until, we come back down here and then the 821 crosses again. And we actually got 3 drives of bullish divergence that lined up perfectly. So essentially, the 821 cross, we're still technically bullish because the 200 exponential may have flipped red, but the 200 simple is still bullish. And then the 821 cross back to the upside, we get triple bullish divergence off the bottom. And then we actually entered into another long right here, which actually took us all the way back up. Again, I think we took profits here and then re-entered right here. But it took us all the way back up to a new all-time high at 70K. And then we just do the same thing over and over again. The 821 cross flips, so we cover ourselves, we come back down here, and then all of a sudden the whole story changes because we're under the 200 exponential and simple, and they're both like red and pink respectively. So now we're no longer looking for buying dips, we're now selling rips. So instead of buying retests of support like we see through here, we're now selling retests of resistance, which is essentially, that's our last bullish play. The reversion to the mean play right here, the reversion to fair value, the retest of those levels to try to save the trend, it fails. And then again, capitulation takes place or like lower lows. So that's my strategy, which I'm very clear about it. And I'm going to tell you the truth right now. Most people will never give away the strategy. If they do anything, they'll sell it for a ton of money. Look, you don't have to use my exact strategy. You don't have to use anything even close to my strategy. But if I show you my actual strategy and explain it to you guys, it's much more useful than if I just sort of like vaguely talk about things and never quite explain it. So in my opinion, the financial aspect of sharing my strategy or giving it away for free to, listeners or participants in the channel or trade group or whatever is much more valuable to me than the monetary aspect of, basically like monetizing it. So that's why I essentially give away the indicators to group members, because they've showed their support. So this was essentially my way of thanking them, which is why it's only available to group members. But that being said, you could still use the strategy. You don't need the moving averages to change colors to see when they cross below each other or the slope is down. But when you look at this chart, anybody can look at this chart and see and have no idea what they're doing. And you're just like, okay, if we see blue lines and green lines, it's super bullish. If we see, red lines and pink lines, it's super bearish. So you can look right at this and say, well, it's all green and blue through here, so that's juicy and we want it. And then it's all red and nasty through here, so it's ugly and we don't. And I mean, that's just the basis of it. And then when you start using some of these other things as well and looking at divergence, and I put these blocks in play to essentially show what the scalp positions were that we took along the time throughout this trade. So here we took a scalp entry at the 821 cross at 10,900. And then we sold the 821 cross back to the downside at 58,250. So just from that 821 cross entry to the exit was a 443% gain. And then by selling the 821 cross instead of just hodling like a little bitch, we were able to avoid, essentially the drawdown of 50%. But again, if you sold right here and then you rebought at the 821 cross right here, you avoided 42% dip. So if here you had $100 and you sold, and then it went down 42%, you could basically buy twice as much with your $100. So it's the same as just doubling your money. The only difference is you doubled it by just selling and then rebuying instead of just the price going much, much higher. So that's why it's so much more important to avoid the losses, because if you just hodled in order to double your money from 58,000, we would have had to go to 116,000. But instead, we sell right here and just saying, like, let's just say you have a Bitcoin spot position and you short against it, or you just sell your Bitcoin and then you rebuy without any crazy, like, complicated stuff going on here. Now we essentially have repurchased twice as much Bitcoin, for the same amount. So we turn that same $100 into $100 in Bitcoin here, but here it was worth, like 0.01 Bitcoin or whatever. And then here it was worth 0.02 Bitcoin. So the fact of the matter is, this little move down and then re-entry right here was the equivalent of 100% or really 84% move to the upside, $116,000 Bitcoin. So that's what trading is all about. It's about dodging the downside so you can capitalize on the upside. And then again, we see, you know, entry, exit, and then, you know, we see the flip starting to take place. And then in that point in time, you know, now we're looking to be, you know, here we're buying dips, here we're selling rips. So, but anyway, that is how my strategy works and how I determine it. And then I use the indicators, the oscillators, divergence, Fibonacci levels, internal retracements, you know, Fibonacci extensions. You know, I have a magic 8-ball that I shake up sometimes. It's not as reliable, but, you know, it gives me confidence. So, you know, that's basically my strategy and compass. So there's your probably much longer answer than you were hoping for. But and also I don't really have a magic 8-ball that's made up. So Bitcoin futures chart looks terrible. It is important now that we focus on these gaps at some point in time, probably way in the future. They might matter, but it is worth note that we basically have this tiny little gap right here that no one really cares about, right there. And then we have also, you know, this has got so much on it. I'm just going to leave the drawing tools off. We just put in this gap right here. So we basically closed at 28,915 on Friday. And then we opened today at 27,300. So now we have this juicy gap right here. So again, if Bitcoin one day, next cycle, goes to a new all-time high, of course we're going to fill that gap. If it just melts down and goes to zero, maybe we never fill the gap. You know, but probability is that we're always going to fill those gaps as long as this doesn't turn into like an XRP, like dying asset, or BitConnect or something like that. So that being said, we're getting a hard sell signal on the daily. We're putting in a new cycle low. So we lost this key levels of support right here. You know, the only lower price action that we have is the tip of this wick. So, you know, maybe we come down here and touch tips and then we get bullish, but I doubt it. This is the new, you know, the spot market close today is the new lowest low of the cycle. The same way that we like gap down here, and this open would be essentially where this open is where the close was on the spot market, because futures isn't open, obviously. So technically we haven't closed a new low yet, but the new open is a lower open than we've had this cycle, which is the equivalent of a new low. So it's basically the same thing. It's just like semantics. So we have a new low. We're clearly in a bear trend, clearly in a bear market. We failed to cross 821 back to the upside, so we can't even look for a counter trend trade right now. And, you know, we gapped down pretty aggressively. So, you know, and you guys know that obviously Michael Saylor is a loser. Wait, that's not what I was going to say. That's not right. I mean, it is right, but that's not what I was going to say. Just for the record, though, if Bitcoin's at $26,000 and his average entry price, last time I checked, was at $30,200, Michael Saylor has managed to lose $4,100 and let's just say $4,100 per Bitcoin so far, which means that his Bitcoin position, which was worth billions of dollars, is now officially down 15%. So I think at one point in time, the Bitcoin position entry dollar amount was something like, I think it was like 2.5 billion or something like that. So essentially right now, he has lost 15% of the 2.5 billion. So that's pretty good. Oh, poor Michelle. Oh, Michael the Failure Sailor, writing the book on how to lose money every single bubble. He nails it. He does a phenomenal job. But anyway, I think we're going to do some technical analysis. What was I actually talking about? Who cares? The gap back here. So we talked about those gaps. Here's our other gap right here that we've been paying attention to. So we left this gap behind when we shot up to the upside and had essentially what amounted to an, at the time, breakaway gap. December 2020. And it looks like we're about to come down here and close that because we're basically at the low, like from where we gapped up. So that is 23,700 roughly would be that. So another, 10% to the downside seems pretty realistic now, or reasonable now. We basically are just surrounded in gaps, which, not a bad place to be. Oh, wait, no, that's technical gaps, not the good kind. But that being said, if we look at our Bitcoin spot chart, the Bitstamp chart, gives us a little more clear of a picture because we don't have that the gap right there specifically. But when we look out at the macro on this, we've talked about this over and over and over and over and over and over and over again. But right now, what we're paying attention to is we have one candle, one monthly candle from 20,000 to 30,000, and we have violated that candle. We're inside of that candle right now. We're not deep inside of it, but not just the tip either. So if we see essentially selling coming in right here, there's literally in all of Bitcoin's existence on God's green earth, there's 1 month worth of price action that took place between $20,000 and $29,000. And now we're penetrating it. So there's 1 month worth of buyers. There's 1 month worth of support in this single candle right here. So as we continue to chew away at it and melt down, it's not unrealistic to think this 1 month candle by the end of the month when it closes is right down here at 20,000. And it has essentially just given back all of that. And that was everybody that bought the blue sky breakout. This was our previous all-time high. We break out right here. Everybody buys new all-time highs because there's no resistance. Everybody's a winner in Bitcoin land. We go to the moon. We never look back. Sure, until we do look back, which is what we're doing now. So now that we fully round trip, if we come back down here to 20K, we have a ton of people that bought, or a ton of volume that bought at that 20K mark or between 20K and 30K. So if we violate that 20K level, we're talking about serious margin calls, because you have people that bought at 20,000 that rode it all the way up to 70,000, didn't sell, and then end up back at 20,000 or possibly lower. That's when you see capitulation events take place. So, and we're very close now on the monthly to the 821 bear cross. Now, it is worth noting, though, that previously when we saw the 821 bear cross, it lined up with the bottom. Here was the 821 bear cross, and it lined up with the bottom. So while I'm not bullish on Bitcoin by any means, of course, I mean, I don't have to tell you that because you can just listen to me, and yeah, obviously. But full disclosure, if this 821 cross happens, which is likely to confirm at the end of the month if we continue selling off, let's say we go down to 20K. Seems likely by the end of the month. Let's say we close at 20K. We're going to see the 821 cross red right here, and then we'll actually be at support with the 821 cross with every other, I say, the last 2 times we went into, the full-on like 4-year cycle bear market. When that 821 crossed, that was the absolute low on a monthly. That was the absolute low on the monthly. So again, don't want to get overly excited, but the same way we look for, bullish catalysts in a bear market or bearish catalysts in a bull market, just to have those hypotheticals already mapped out and see like, hey, is there a chance that we come back down, retest 20K, it turns out to be the macro bottom, we go sideways for a couple months around that level, slowly start floating up, and then over time, we get back to the next halving event, and then start shooting off, and the next thing you know, we're at all new all-time highs, and the next 4-year cycle has begun. That is 100% a possibility from 20K or around that level sometime, in the next, 18 days left in this month, and another, 30 next month roughly. So sometime in the next 50 days, we could actually see a macro bottom on Bitcoin and crypto. It probably doesn't happen, and they're trash. They probably all just go to zero, but it's possible. Now, that being said, that's not my base case scenario by any means. It's actually the opposite of that. But there is a viable argument and possibility to be made, based on what's happened previously, that we could actually see a bottom around support, around 20K in the next 50 days. But again, it's not going to happen, and crypto's probably just all going to go to zero. So Bitcoin's going to zero. And if you don't know what I'm talking about, just look it up because it's hilarious. Anyway, so that's our monthly chart on Bitcoin and how that's shaping out. Obviously, bunch of bearish momentum. We flipped the slope line red on the TJD, TDMACD. The Jewel Thief stochastics are just powerfully accelerating to the downside, and we're about to get the 821 cross, consistently putting in new lows. We have violated key support levels, and the single month candle. So 20K, then essentially we have to really start looking at, what amounts to like 14K or 10K if we start violating those levels. And it's going to be like stairs. So it's not going to just happen overnight. And then it's like, oh, now we're at 8K. Man, I can't believe I went to sleep last night. No, it's going to happen down. Then we go up, we go down 20%, then we bounce, 30%, then down another 12%, then we're up 40%. And, the stairs, the slinky theory, full effect. Bitcoin weekly, We violated 200 exponential. We're headed down to 200 simple. So that target's at 22K. So basically, there's targets the whole way down here, you know, every $2,000. So when we were at 28K, we said next target 26K. Then from 26K to 24K, then 22K, then 20K. So it's basically just every $2,000. I mean, in all reality, as basic as that sounds, you're like, hey, thanks. And then when we look at the daily, you know, just completely melting down. Obviously, just looks very, very bad right now. So, and, you know, realistically, what is happening right now is crypto just basically telling us what's about to happen tomorrow in the stock market. Bearish continuation? I would say yes. I would say very much yes. ETH looks like trash. You know, this is the low on Bitcoin. So right now we're basically threatening that wick low right here on Bitcoin. We're like around here. Ethereum is substantially lower. It actually pushed all the way back up, violated those levels, and is substantially lower since then. So from when Bitcoin hit its low to right now, it's basically dead even from that wick low. From when Ethereum hit its low to right now, it's down another 22%. So in the last few weeks, Ethereum has underperformed Bitcoin or overperformed it to the downside, depending if the race is to zero or if you're trying not to lose all your money. But Ethereum has done 20-something% worse than Bitcoin in the last couple of weeks, which doesn't surprise us because obviously it's trash. And also, the Bitcoin dominance chart. That's the one. That's the one. The trash has nothing to do with it. And keep in mind, please, that when I call all these cryptos trash and all this stuff, my channel is called Crypto Trend Trader. I love crypto and blockchains. I've been an advocate of the space for a long, long time. But, you know, when assets charts or technicals look like trash, I'm going to call them trash, at least for the time being. And then, you know, when things change, you know, maybe I'll just call them trash, but I'll say they're bullish. Maybe I'll be like, this is legit. This is it, guys. But please don't get turned off by, you know, me being mean to like whatever your favorite asset is. So yeah, Ethereum looks absolutely horrendous. And we've talked about these key levels and how Ethereum has essentially already done what the whole world hopes Bitcoin doesn't do, or prays to God Bitcoin doesn't do, or I don't know. I think most crypto people probably like burn sage, turn off all the lights, and like probably pray to something weird and not good. You know, aka cult reference. But that being said, they pray to like whoever like the founder is. They're like, oh, CZ Binance, we love you. whoever their cult leader is for their crypto coin. But Ethereum has already violated that 2018 high. So everybody's afraid Bitcoin will do that. It's never touched its previous all-time high before. Ethereum doesn't have the same history, obviously, you know, because it's Bitcoin's little baby. But that being said, we have already wicked into or gone into the wick area from the 2018 high. So Ethereum looks terrible right now. This is if Bitcoin does what Ethereum's doing right now, there's some legitimate arguments that we're about to see a 5-wave retracement and Bitcoin goes way, 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 way lower. Lower than we've ever seen it go before from, you know, historical percentage wise. You know, and that's my macro 5-wave thesis, which is essentially that Bitcoin's entire existence is about to get retraced. Not the whole way, but a Fibonacci retracement of price action from 0 to 70,000. And if you haven't checked out that video, go watch it because it's awesome. But I also am biased because I made it. So Ethereum monthly, trash, momentum to the downside, garbage. I mean, we've hit all of our targets. Should we even make more targets? We just keep hitting them all. So we hit our target here. The next target was, what was it? Our moving average on the weekly. We hit that. Blasted through it. So now we have the 200 simple at 1221. We have the 382 at 1,000. So I guess those are our next targets. But yeah, thanks Ethereum for making us always right as you literally melt down. So next we have the Bitcoin dominance chart. This is the one. So we've obviously taken out that high now. We got a new close. So we had triple bullish divergence on the Bitcoin dominance chart, telling us Bitcoin was about to gain market cap in comparison to cryptos, marking the absolute bottom in, you know, basically like Bitcoin's dominance. At that point in time, came back up here, hit the top of the channel, put in our third, you know, lower high series right here, closed above it, opened above it, closed above it, and then we were extremely bullish on the triple bullish divergence, but got extremely, extremely bullish for the breakout. Now we're looking for the measure move up to 51%. And then after that, the final is the reversion of the mean, the retest, the return to fair value for Bitcoin. After being smacked down like a little bitch by all the crypto scams, Bitcoin may one day reclaim its true place in market cap or market dominance with 56%. So there would be 56% boomer coin and 44%, well, maybe 43% trash bag scams and 1% legitimate projects that one day will change the world as we know it. So yeah, you guys know what's going on there. But obviously, Bitcoin dominance chart was just absolutely beautiful for nailing the, the bottom or top, depending how you look at it. Essentially telling us, hey, we don't want any more trash bag altcoins in our portfolio anymore ever again for at least some months to possibly years. And we were right. It obviously worked out perfectly because altcoins are getting absolutely wrecked. Total market cap on the weekly. So we did it. We made it to $1 trillion. We did it, guys. Woo! We made it to $1 trillion. Yay! I remember back here, we were so excited when we made it to $1 trillion. And I'm just not sensing the same level of excitement now that we made it to $1 trillion again. Maybe because 66% of crypto's value was destroyed from 3 million to 1 million. That might be why, but so yeah, hit another target. Oh, we nailed it. We did it again. Oh yeah, it worked. Technical analysis is great. $840 billion is our next target. And I fully expect us to get there. And then at that point in time, it's very important to pay attention to, the same way we do on the actual Bitcoin chart, the market cap. I mean, this chart looks exactly like the Bitcoin chart, but 768 billion was the previous all-time high from 2018. So we're almost there. So again, we're starting to look like basically that retest of the previous high. And, obviously, historically, we've never done that before. But, we have pretty limited data, so it's not surprising. But looks absolutely horrendous. And, fully does probably go to like 850,000 very, very soon. Probably in the next month or so. Avalanche. I'm going to really just speed through all these trash coins because there's just nothing to see here. Complete and utter meltdown and destruction. The race to zero has started. Matic still kind of hanging on, but again, new lows. Looks very much like it's going to come down to our 200 exponential and simple on the weekly, around 30 cents. Obviously, that was the daily chart, but that's what our box represents. Solana, complete meltdown. Already hit the 786, consolidated, descending triangle, meltdown. And again, there's nothing left on this bitch. It's a wrap. Basically everybody, I mean, there's some support along the way to like 23 or something like that, but these cryptos are wrecked. Now, granted, I'm looking at like the Coinbase charts on these specifically. There's a lot more history and support on like other charts, exchanges, etc. But most things, as they're getting ready to get listed on Coinbase, have like a big run up leading up to it. And then they kind of like consolidate and then they've gone much higher. But the reason I like looking at Coinbase is it's the largest American exchange, United States exchange. So you can see when the majority of like United States investors, the absolute lowest price they possibly could have gotten in, at least on Coinbase. So if we're down here at the basically lowest price they've ever been on Coinbase, it means literally everyone that has ever bought this since it was listed on Coinbase is a loser, which is okay. There have to be losers. Not everybody could be a winner. But like, if this is our pile of losers right now, and then here's our pile of, winners right now, we'll go Wix. I mean, who looks like it's going to win? I mean, look at the losers, and then look at the itty bitty little winners right here. That doesn't make me bullish on an asset, because every time we try to move to the upside, there's 4 million people dumping on your face trying to get out of their position, as opposed to like, the 9 people that, basically will like be buying support. So the likelihood of us having a bullish move without putting in a clear bottom and building up some momentum and just a long time and taking place and just a long drawn out carved out bottom where everybody forgets about all these cryptos and they're all dead projects and everybody goes, crypto, that's a pyramid scheme. I lost my life savings. Oh, my mom bought into Dogecoin and she lost it all. Crypto scum. I mean, it's the same thing we heard all through like 2018, 2019. And that's what I would expect to happen going into the future, because it's all cyclical. It happens the same over and over again. XMR, Monero. So we nailed this one. One of the members brought this to our attention. There was a really nice trade here. I know some of you guys did very well on this. But I mean, this is real as it gets. Monero looks like trash. It had some nice short-term moves up here, but it is one of the worst cryptos on like the longer time frames. just in that it's already like melted down so far. Most other cryptos have not hit their 200 simple yet. And it already like blew through it with that wick. I mean, this thing just looks rough. There's just a lot of potential, headwinds for this. And then with potential like regulations coming in and stuff, they're going after two main things, stable coins and privacy coins, like more than anything. But we're about to get the 821 cross on the monthly at the end of this month already. Last time it happened, this thing just melted down afterwards. So again, even if we say, okay, the cross is the bottom or within one candle of the bottom, keep in mind though, on Monero, for instance, that 1 month or 2 months down from when the cross took place to when the macro bottom was in was 68%. So you're like, I'll just buy the cross down 68%. And you're like, and we bottomed. And then actually Monero is a weird one because it actually had like a capitulation wick down here on Kraken. I don't think that's on most things, most exchanges. So anyway, Monero, I mean, I just hate all the headwinds on the, I mean, I hate stable coins, one, but I hate privacy coins just because, like, I don't dislike them and what they do, but like technically or like fundamentally, I just think they're going to be in real trouble because governments don't want privacy coins. They don't want that. They want the opposite. They want, we know everything you do and we control it, coins, aka central bank digital currencies. So we talked about algo and the potential for the support holding right here. Obviously, you guys know I'm not bullish on these cryptos, but we have melted down below 618. So once we violated that level, I mean, next target to downside 786. Definitely looks like trash. Holding up better than a lot of other. I mean, not really though. Let's be real. It just has more history. It's trash. XRP is probably one of the worst. I call a lot of cryptos trash, and they're really not. But XRP is actually trash. Complete meltdown. I would imagine this thing is going to zero pretty soon here. I think like 25 cents probably is the next little area of interest. And again, this thing is just absolutely garbage. Absolutely garbage. 821 cross or on the monthly already has occurred. Just completely melting down. I mean, I think realistically like 21 cents is probably like key level of interest on this. Cardano is holding up a lot better recently than most. So we see Ethereum is substantially lower than its capitulation low. Bitcoin is basically at that wick capitulation low. And, arguably Cardano holding up a little better because it's not yet. But when it loses its 382, which it fully will very soon, I expect, I do think Cardano goes to 24 cents. Obviously, that's our target. And then we look for a potential, play from there. 24 cents. I remember when this thing was at $3 and everybody was really excited. And now it's at 46 cents. Sorry, that's not funny. KNC. So we talked about the hypothetical scenario where it comes down and puts in a higher low, and then it could essentially like start marching to the upside before a breakdown. Obviously, the hypothetical scenario did not play out because we violated that potential support area at the 236. And at this point in time, realistically, once we come back down below the 236, we're more likely than not about to put in a new low. So I think realistically that this was just like the A, the B, and then we're in process of putting in the C right here. So something closer to, and again, we put in these hypotheticals so we could look at what a potential bullish scenario would look like. The same way we put in hypotheticals and look at what, a bearish scenario might look like. Neither one has to come true, but we're able to use technical analysis, targets, previous, experience, etc., to get those key levels and like potential possibilities, probabilities, etc. So it sort of looks like we're doing something like this, where we're kind of putting in like an ABC creeping down here on KNC to come back and retest our target of 80 cents. So we identified that 80 cent target a while back, and I think that's probably where we're headed right now. We'll see. Let me do one more thing though. If we put a fib from the bottom right here to the top of what we're calling the B right now. So we're at the 786. So maybe it finds support right here and reverses. I don't think it's likely, but it is possible. But it would essentially give us something a little closer to like that. And then maybe we have like, a little more of like just a regular, channel kind of consolidation. and then we break down eventually. We'll have to see. But again, I don't think this thing is just going to all of a sudden get bullish if the rest of the crypto is bearish or stocks. I think everything has to kind of move together. I mean, it all moves together clearly. But in order for one thing to be bullish, the probability of picking the right one thing is extremely low. So there's much higher chance that we see, a all around bear market rally. And that's the moves that we're looking for in like some of these cryptos or some of the like stocks for like the reversion to the mean, etc. But again, it doesn't look good. Doesn't look good. Definitely just confirming into a bear market. So just put in a new all-time high as well. So people got absolutely wrecked on this because it literally went from the all-time high to down 76% in 44 days. So somebody just lost 76% of their money, and they did it in record time. Congratulations. You just broke the world record, sir. Lost your money faster than anyone else. Not the kind of record you want to hold. So Hex looking like trash. Obviously just complete and utter meltdown. Not only did we come back down and fill in that wick like we were discussing, we actually closed, but we wicked another wick. So now we have another potential wick to fill in. But complete meltdown, no surprise. We were talking about that target at 4.2 cents. Obviously just blew straight through that. But we know the real macro target, the one we're really looking for, is the 0.023 cents. So 2.3 pennies. Yeah, not good. Complete and utter trash. And this is another one where, it put in its high a while back, but I mean, it is currently down 92.3, wait, 93, let's round up, 93% from the all-time high. It's down right now. So you're like, I have $100. I'm rich. I only have $7. Crack me up. And then waves to the US. Yeah, looking pretty rough right now, honestly. Looking pretty rough. So we were talking about that 618 potentially holding. Didn't seem likely for that reversion to the mean play, but I mean, the truth is, this looks like it wants to melt down. We're at that previous high we had talked about right here. If this level gets violated, though, realistically, probably going to 786. So I think this is probably our heads up target right here. Looking for that sweet $3.20. Seems likely. So remember, none of this is financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. All right, we're at 2 hours. We got to rip through these. Or you know what? Let's just skip commodities for today. Because we did them on Friday. Everything's been closed. So we saw a little pop up here on gold and then, a little pressure. But there's not really anything that's changed from Friday to today. So yeah, so we'll wrap it up right there. And then anybody that put in a request for an asset in the group that I didn't do, I'll do some charts in the group. And then on Wednesday, I will specifically do all the assets from chat and the group. If you just remind me what they were, I'll make sure all those get in on the Wednesday stream. But yeah, that's my fault. So yeah, we'll go ahead and wrap it up there. So hopefully everybody enjoyed the stream today. Make sure that you like and subscribe. All that good stuff. Obviously, a big week coming up in the markets right here. So we have the Feds basically looking at another 50 basis point hike potential, starting to be priced in for like a 25% probability of 75 basis point hike. I don't think it matters either way. I think they probably go 50. They've been pretty clear about giving the market a heads up on anything and everything they do. Jay Powell has literally articulated everything. I mean, he's basically like narrating everything the Federal Reserve does in advance. So I don't think all of a sudden he's going to be like, we're going to 75 basis points, bros. No, I think they're going to do 50 basis points. If they go to 75, I mean, I don't think it changes anything one way or the other. I don't think all of a sudden if they come out and they go, we're going 75, and then it's like, oh, thank God we fixed the inflation problem. No, I think consistent rate hikes over time and then actual time itself can fix inflation. But realistically, I don't think the difference between them going 50 or 75 at this meeting makes a lick of difference in the entire world. Now, if they said we're going 1%, 100 basis points, that might be enough to like shock the market or at least like, you know, get a reaction. But I don't think so. Don't see it happening. I don't even see 75 happening. So, all right. So let me jump over in the chat here and then we'll wrap it up. All right. So we identify top and bottom risk. Parag says it was announced in April stock split. Yeah, I totally missed that. That's crazy. J Hoff, maybe you did hear and just thought it would be a good idea. Yeah, I don't know. I feel like if I would definitely remember if I heard. I don't know why or how I missed that one, but or maybe it just kind of like got bundled into my memory stack with like the split in Amazon. I don't know because I've been anticipating that split in Amazon, talking about it, and I honestly did not know Google was splitting, and definitely didn't see like the little S on the charts. So, what's going on, Honkiness? Good to see you, man. No worries about being late. You can always rewatch it later. Prague says, thank you. Amazing. TU, I'm assuming you mean TA. Free Alpha, thank you so much. Much appreciated, of course, brother. J-Off says we pray for Elon. I think Elon needs to pray for us. But he has forsaken us. He forsaked us with the Doge. Ralph says, laugh my ass off. Definitely not the same level of excitement. This time in a trillion. Yeah, I don't know what it is, man. I mean, if everybody got excited when we hit it the first time, I don't understand why they don't get excited this time. Maybe because they're down 66%. Hunkiness says, it's amazing that there aren't 50,000 watching every stream. Clown world. Yeah, that's so true, man. I mean, I would say probably like one of the top comments that I get is like, I can't believe your channel's not bigger, man. And then they'll list off like XYZ, like crypto channels, and they'll be like, these channels are trash and they provide no actual value and have, you know, 1,000 times the subscribers and viewers you do. And that is the difference between entertainment and education. You know, I try to be at least vaguely entertaining. I definitely entertain myself. I hope I entertain you guys as well. But the key here is education. The most important thing is education by far on this channel. So, you know, I look at this as, I don't want to say it's like, it's not charity work, but it's like, you know, good deed type work. You know, because the amount of time that I put into this channel versus where I could put this effort and time somewhere else, and the amount of money that I could make or fun that I could have not spending my time doing this is exponentially more valuable to me. So realistically, this is not, you know, I don't do this for the money. Now, obviously, as a businessman, investor, etc., you know, I'm all about various streams of income and, you know, investments, etc. So I look at this in many ways as an investment financially in the future, in the sense that over time, eventually, you know, I'll probably monetize the channel, and a lot of the work that essentially I put in advance, I'll get paid for, you know, dividends later on, you know, building my channel up, etc. But the truth is, it's really not for the money. I mean, and then obviously, you know, we have the group, so that's a way that people are able to, you know, support my work and, you know, essentially make it worth my while to get on here and do it every day. But you know, to tell you the truth, man, all the kind words and all the people that have told me they've, you know, that I've helped them or they've made exponential money, or, you know, it's great when people say they've made money, but to tell you the truth, it means a lot more to me when someone says like, man, I saw your stream or watched your channel or been following you, and you have taught me so much and saved me from some nasty falls. And obviously none of this financial advice. I'm not your financial advisor. Markets are extremely volatile. Please do your own research, trade responsibly. Don't do anything based off anything you see or hear on this channel. But the idea is to point out what I'm seeing, and then you as an adult can make your own educated decision on what you want to do. So if I influence that in any way, shape, or form, you know, that's not good. You should be doing whatever you're doing on your own. But I understand how reality works in real life. So, you know, the truth is, I do appreciate all of the kind words that people share with me. So, all right. So I think that's it. Completely agree. Great stream. Yeah. Thank you guys as well. Thanks everybody for tuning in today. Going to go ahead and wrap it up there. This is our Sunday evening market look ahead. It is 10:14 p.m. Eastern Standard Time on 6/12/2022. I am Crypto Trend Trader and about to wrap it up. So make sure you check us out on our next stream Wednesday evening from 8 p.m. till 10 p.m. And then, of course, our Friday stream every single Friday from 11 a.m. till roughly roughly noon or 1 Eastern Standard Time. So, but that's it. Everybody have a great night. Appreciate all of you guys, all the kind words, all of the support. And that's it. Everybody have a great week. We'll see you Wednesday. Crypto Trend Trader, peace out.